Hit it.
It's Friday, March 19th, 2021, episode 123. It's Patrick Ceresna.
And I'm Kevin Muir. We welcome to the show Aidan Garrib from Pavilion Global Macro. We have a terrific discussion about China's macro plans, the way to trade the whole growth versus value dynamic, and why Aidan is not allowed out after 8 p.m. Then fan favorite Morris Sachs joins us to talk about markets. At one point, he made Leena spit out her coffee with laughter. We'll let you guess when. And then at this point, my partner, the dark arts wizard himself, Patrick Ceresna, regales us with feats of sorcery with his technical analysis in talking charts.
And this week in trading history, we go back to when JP Morgan buys Bear Stearns during the financial crisis, and we end with our segments of No Stupid Questions. And Kev, I'm looking forward to talking some skin in the game. So folks, stick around. We may even drink some beers along the way. Leena, hop on here. What beer are we drinking this week?
Today we're drinking Great Lakes Brewing Company's Hanlan's Point Coconut Coffee Porter.
Oh my God, what the hell did we get ourselves into?
We let Leena choose it, and I saw it, and I was like busy trading, and I was like, oh God. So we got a porter and another coffee thing, and we got coconuts going on.
I figured, you know.
And the only thing is that the saves it is it's a terrific
image.
Yes.
Now, are you going to talk about the Hanlan's Point?
Oh, do you want me to talk about it?
Yeah, why don't you tell us?
For those that don't know, we have Hanlan's Point is a part of the Toronto Islands that is the clothing optional beach. Let's put it that way.
There's a whole little section here, though. In 1997, Gordy Levesque, which I've decided Gordon is the most Canadian name ever, attempted to make his first trip out of Canada. Unfortunately, they informed him at the airport that he needed a passport to fly. Undaunted, Gordy took his Speedo and hit the closest beach he could find. He spent the remainder of the winter sipping on Mai Tais. Legend has it he survived only ice fishing and popcorn from the previous summer at Centerville.
There you go.
It's hard to read.
Hilarious.
My old eyes were having trouble with the cans. Now listen, Great story, but it's absolutely terrible. I've already taken a sip. It's just like no amount of coldness is going to make this drinkable.
I'm reading the description here, and there's nothing that you like in this description.
No. It's this is going to be a struggle throughout the show.
Just
All right.
Amplify your loss in the.
All right. Anyway, so give us a disclaimer, Kev.
Okay, side effects. Nothing in this let's try that again. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include speculation intoxication, bullion bank blues, and coronary chart disease. That's what I feel like I get when
I'm talking to your chart.
Yeah.
All right.
And actually, before we do anything, we have a huge deck today and
slide deck.
A slide deck. That's
from
correct.
Aidan.
And Leena's asked me to remind you all that don't forget, if you sign up for the email, you will get a link for the every week. You'll get a link with any sort of materials. And if not, and if you've missed it this week and you want the deck, make sure you go and have a look at Twitter. We'll post the link there.
All right, so let's get on to Aidan. We have a great pleasure to welcome back to the show Aidan Garrib, who is the head of global macro strategy and research over at Pavilion Global Markets. Aidan, how you doing, buddy?
Hi, Patrick. I'm doing very well here. I mean, under lockdown in Montreal, but it's hopefully going to let up soon, and I'll be a free man.
It's in La Belle Provence. The Belle Provence is just like us. They're locking everybody out.
Yeah.
So are you guys, is spring come yet, or is it still below zero?
Spring has come. It's very sunny outside, but with this 8 p.m. curfew, you don't get to enjoy much of it. Actually, I think they extended it to 9:30, so I can leave my house now. I'm not in a rush. But spring's coming.
You guys actually have a curfew.
Yeah, police will fine you $3,500 unless you're walking your dog. So, funny story very quickly. A husband and wife couple decided that the husband would dress up in a dog suit and go on a leash, and his wife would walk him. Now, the police didn't like that very much and fined them both $3,500. So that's an expensive practical joke.
I would have done it. That's all.
Well, who knows? Maybe that's just a regular Friday night for them. Okay, Aidan, you brought some great charts for us. Let's jump right into it. The first one is something that I actually, Aidan, I have to give you a little bit of a shout out here. I borrowed this chart for my post today. I hope
No
that's
problem.
okay.
No, it's great.
Okay, because I do love it. And why don't we talk about it? It's China's credit impulse. This is something that you've been talking about, and I don't think gets nearly enough play. Why don't you tell us what we're looking at and what you think it means?
Sure. I guess so. To take a step back, what I would say is what I want to explain on this presentation or get out is that I think there's a shift in global reflation where China is passing the reflationary baton to America to drive global reflation. And I think that has some important consequences for the global economy and for how investors allocate capital, because China's credit impulse tends to be more stimulative than when the US is driving reflation. So yeah, this chart, I love to start out with it. And it's so important that I term it the global economy Superman, because what I try to show in this chart is that every single mini cycle of global reflation, which I proxy global reflation with commodity prices, but you can use PMIs, you can use different things, but commodity prices are a good proxy for reflation. Every single mini cycle of global reflation since the GFC has been driven by Chinese credit. And where I think we're at currently is a scenario where, kind of similar to the GFC. So what do I mean by that? Well, coming out of the global financial crisis, America's economy was weak, Europe's economy was weak, and kind of still is. And so it really came down to China to stimulate and get global growth going. Well, you know what? That's by and large what they did. They stimulated to the hilt, drove global reflation coming out of the GFC, and gave America and Europe enough time to kind of get their houses in order. And then once that occurred, China slowed their reflationary impulse quite dramatically. Now, I think we're in a similar situation to that, where in the COVID recession, there were lockdowns basically everywhere, and we're still in a lockdown here. The West and Western economies could not drive global reflation, so it did come down to China, who escaped COVID, much earlier than everyone else, to drive this reflationary, impulse here. And so it looks to me that now China is starting to draw down on that credit impulse. And I think that this is important for a number of reasons because of the impact that it has on global assets. So, in this chart, I'm linking Chinese credit to commodity prices. But if you, go one page down to page 3, what I'm doing here now is linking commodity prices to MSCI EM ex China, so emerging market equities. And so essentially in these two charts, I'm connecting Chinese credit impulse to emerging market equities. And you can see here that EM equities have gotten a little bit ahead of themselves in relation to commodity prices. And when you tend to see this type of activity, where the equities rally more than commodity prices, it tends to be the equities that correct downwards here. And so what I think is important is to examine, exactly what we think China is doing, because like all things out of China, you don't know for sure, but you kind of have to, put the puzzle pieces together here. And so if you go to the very next page, page 4, I don't want to come off too bearish here, because what this chart's showing you is China's monthly copper imports, which are still growing at 512,000 tons per month. But it's just the second derivative is slowing down. So if you think about the global economy like a boat, and China's that wind that's kind of pushing the boat, it's just that wind has started to dissipate somewhat, right? Where earlier this year, and for the bulk of 2020, China was importing quite literally, it's not hyperbole to say, a record amount of copper in volume terms. And so this is kind of slowed. But, to put this in context, at 512,000 tons per month, it's still more than double what China was importing, in the early 2000s, between 2001 and 2007, which was the heyday of their industrialization, when they were building the roads and bridges to nowhere we've all come to know and love. So the reflation is still occurring. It's just the tailwind is starting to dissipate somewhat. And so it's interesting over the next few slides to go into, what we think China's doing in terms of passing on that baton and driving growth within their economy, and how accretive, what America will be doing for the rest of the world.
Can I jump in here, Aidan? It's Kev.
Definitely.
Okay, so some great stuff there. Can we just backtrack to the first slide? And I'm just curious in terms of like when you talk about this credit impulse, how do you actually measure that? Like, what is that? Like, why don't you explain to people what a credit impulse is and, how you're coming up with that number?
Sure. So, anyone with a Bloomberg terminal can kind of get it. But what it is it's the pace of growth in aggregate credit to GDP. So it's just how quickly aggregate credit as a share of GDP is growing or not growing.
Right. And then so when we're looking at that, although you're absolutely correct that China, especially in the aftermath of the GFC, led the way out, isn't it true that this time China actually, as a percentage of the stimulus coming out of the COVID, was actually less? And wouldn't you argue that maybe in some ways actually China has become less important than it was during the 2008 kind of recovery?
Well, so I don't. And the reason I don't is because you're right on the fact that Chinese stimulus, compared to the amount of stimulus coming out of the U.S. or even the Eurozone, is a little bit less. But China's stimulus is going directly into the real economy, whereas in the U.S. it's just been basically going to keep things flat, right? Like just kind of fill the void.
Okay.
And
so your argument is it's more actual infrastructure spend and investment as opposed to just kind of fixing a short-term demand problem.
Well, for sure, because I think if you go to page 4, the chart just directly, previous to this, look, China is responsible for 50% of base metal consumption globally, right? They're the elephant in the room. And when you're looking at China importing, record amounts in volume terms of commodities, and again, I'm very careful with the words I use here. And when I say record amount, that's not hyperbole. That's quite literally, what it is. And it's still double the volume that we were seeing in the early stages of China's industrialization. This has been what's been lifting kind of the commodity boats. And I'll give you some other examples, right? So last year in June, they had the single largest shipment of soybean exports from Brazil to China. And that was partly due to some reasons I'm going to get into, where you had the RMB, so China's currency, had appreciated 41% versus Brazilian real year to date up until that point. So China was essentially importing soybeans at a 41% discount year over year. Another example is oil. When oil prices went negative last year, China hired 70 very large crude carriers. So the VLCCs, those are kind of the largest ships that can transport oil. 70 of them to transfer oil from Saudi Arabia to China. And they filled up their entire, 3 phases of their strategic petroleum reserves in one foul swoop.
Whoa.
So
I didn't realize that. So they had been building an SPR, or strategic petroleum, an SPR, and they actually filled it when oil went to the stupid negative price.
Yeah, just trying to being what do you do, right? You
Opportunists.
Can't help them for it. Exactly. Yeah.
Oh no, I'm not. I'm saying good for them.
Yeah.
Okay, so they come out of this, and we have the COVID crisis. They do the impulse. Some debate of whether it's as big as the last one. At the very least, you think it's driving the world economy, but yet you see the impulse rolling over. Why don't you walk us through the next 2 your slides and what the kind of message is that you want to give?
Sure. So again, China is very opportunistic, and their policymakers think very, they think longer term here, right? So when you look at this chart, page 5, I'm showing you commodity prices denominated in RMB, so in local currency for China, as well as Chinese PPI, so producer prices, and then CPI, consumer prices. So it's no surprise that in 2020, China was importing this record amount of commodities, because commodity prices there, as you can see this dark blue line in 2020, they were down almost 10% year over year, right? And I gave you the example of soybeans, which had fallen 41% 4% in local currency terms for China. Well, that's no longer the case, right? You have commodity prices that are up, 17% year over year in RMB terms, and to kind of steal from Patrick's other podcast on Macro Voices,
the one where he cheats on me.
yeah, that one. I was just a sore spot here, but I think it was Russell Clark was on, and he was talking about when prices go up for goods that China can't control, then they crack down on the prices for the goods that they can control. And so I think that's kind of what you're seeing here, where China's been kind of in this trap now where commodity prices are really rallying, producer prices are up too, and consumer prices are in deflation. So what this means is producers are having a hard time passing on these costs. So what China's doing now is they're going from importing commodities to actually putting these commodities to use. And I think this has been a very smart kind of plan that they've been adhering to here. So I'm going to get into this on the next slide, which is another interesting credit chart that few people talk about in China. So this is undiscounted bankers' acceptances. And so it's not a huge proportion of credit growth in China, but it's an important component of credit growth in China, because undiscounted bankers' acceptances are one of the major ways that Chinese firms build working capital in order to start, going through with, building up industrial inventories and financing their industrial process here. And so, whereas that light blue number, which is the month over month change, that's very volatile. So what I tend to do is I look at the 6-month moving average of that, and you can see that line tends to lead industrial inventory growth. And so what we're seeing now is undiscounted bankers' acceptances, that growth is starting to pick up, i.e. Chinese working capital within the manufacturing sector of the economy is starting to pick up, and that tends to lead to growth in industrial inventories. So in short, what China is doing is they've spent the last year opportunistically importing a lot of commodities at very low commodity prices, and now what they're doing is commodity prices have rallied. Okay, let's put these commodities to use. So, the next question is, well, okay, what is China really doing with this? And what is the outlook here for how investors want to be, positioned? And so this chart as well, I don't really see that often, but it's China's industrial robot output. And so the reason I'm showing you this is because I think the Fed has essentially allowed China to win the trade war, right? Because China has this de facto pegged currency to the dollar, so they can only create credit insofar as they're getting foreign capital inflows. Otherwise, they risk their currency peg kind of blowing out. So what do you have when you have Fed funds at 25 basis points and rates in China that range from, call it 2.4, 2.5 at the front end of their curve, to 4% as you go out to the 1 year lending the medium lending facility rate. So the interest rate differentials have helped suck capital into China, allowing China to import these commodities. And what China is doing is they're trying to win the trade war, right? Because China has an aging population. And if they want to win the trade war, they need to get wealthy before they get old. So China knows that they're not going to get wealthy before they get old if they're just hawking DVD players and T-shirts. They need to move up the value chain and make their economy more competitive. Well, one way to do that is to invest in industrial robots, because when you look at industrialized economies, whether it's Korea, Japan, US, Germany, the bigger the proportion or the higher proportion of industrial robots you use in your factories, the improved productivity that you get, and you're able to lift wages that way. Now, the other thing that China is doing here is they're also trying to become self-sufficient in technology, right? In semiconductors. And I think you see this on the very next page. So if you go to page 8 in the deck, so the next page here, you will see China's investment. So the dark blue line is integrated circuit output, and the light blue line is fixed asset investment. That's FAI in computers and equipment. So look at the surge here that you're seeing, right? So this is semiconductors, right? China wants to become tech self-sufficient. And so all of this is very copper intensive because you need copper to intensify your grids. They go into the manufacturing and industrial process, and essentially computers and tech hardware is very, copper intensive. So China here is trying to, win this trade war. So they've imported a lot of these commodities, and now it's time to put these commodities to use.
So, Aidan, actually, I think this is a great topic because there's all sorts of news in the headlines about Honda having to close or close down their line because they can't get semiconductors. We see things about Biden wanting to be U.S. kind of semiconductor self-sufficient. I'm wondering, are we entering into a new kind of China-U.S. Cold War in terms of technology?
I don't. In some technologies, probably, but for the most part, no, because semiconductors are not something you can just. So China's kind of history with industrialization, and to be fair, it's not just China, but it's tended to steal intellectual property and then try to mimic and build out or just buy out those firms that kind of have the expertise. But China's not had much success doing that when it comes to semiconductors because China is able to produce a lot of the low-end, low-quality semiconductors. But for the advanced high-tech stuff, there's still only a few firms in the world that produce that, and one of them is sitting just outside of China's, I would argue outside of their territorial border in Taiwan, which perhaps makes that particular semiconductor foundry one of the most important companies in the world. But I guess to answer your question succinctly, it's not quite a war yet because China can't produce the sophisticated semiconductors yet. They're still trying to do that.
Okay, the other question I had, and just before you get off this, is we were talking about the fact that China has a higher real rate. And you were saying that they suck capital into China and then that they're putting that capital to work. As an investor, do you feel that going and picking up that yield is a trap? Do you feel that if you were an investor that was looking at the real yields throughout the Western world as being much lower, this is a good alternative?
Yeah, so that's another great question. So on I think there's a good case to be made to stay clear of the corporate bond market in China, where you're not actually sure these things are investment grade, and there's a lot of defaults, and it's kind of a mess. On the government side, I think that there is a very strong case to be made for Chinese government bonds. The reason being is that it's in China's best interest right now to attract as much foreign capital into their bond market and help internationalize the RMB. And so, I don't think they would do anything detrimental to foreign investor sentiment, unless things really got out of control and they had no choice. So, if you're picking up hundreds of basis points of real yield in China above what you're getting in Western bond markets, I think that continues to be an attractive asset classes, and I think institutional investors are definitely piling in there.
Yeah, I saw the other day that Russell Napier, he had a big pushback against that. He was much more in it's a Cold War, and if all of a sudden something happens, then the last thing you want to have done is bought these bonds. Who knows? I feel like you, but it's got a little bit of more of a political, little spice in there in terms of it's not quite the same as buying German or Japanese or U.S. bonds, is it?
Agreed. Yeah. So there's a lot of that political uncertainty in there. So look, I think if you look at it from just the markets, from just, where am I picking up positive yield? Are Chinese bonds attractive? Definitely. When you start to overlay some of the, the political risks associated with that, then, I think there's the case to be made that, they're less so, and that
Right.
Russell Napier has a point. I would definitely agree with that.
Okay, so let's go on to your next slide here.
Okay.
It's VS swooshes and other shapes. I like the name of the slide.
Yeah. So I think, and so this lays into this slide I really like because I think it ties in China's decision making with now passing the baton to the US. Because what we've seen in the US has been this outrageously strong durable goods consumption through COVID. Because for the people that kept their jobs and were locked down, they went out and bought new houses, cars, and RVs, right? And I think everyone expects that as the curfews here, as the lockdowns get lifted and life returns to normal, you're going to see less durable goods demand, because how many cars, houses, and RVs can I possibly buy here, and TVs, and all the rest? And what I'm really craving is to go out with my friends and my girlfriend for beers and dinner and all this other stuff, right? And vacation, so consuming services. And so China, seeing this, is thinking, well, okay, look, we have done pretty well over the last year by exporting a lot of these durable goods to America. And now, if Western and American demand for these durable goods is going to start to slow somewhat, then it makes more sense for us to really focus on our industrial process and building the robots that they're building, and the the semiconductors and the integrated circuits. So I think China's kind of looking at this and expecting the winds of reflation to kind of shift within this. And so I think this has broader implications too as we move on for how you want to be positioned within asset markets here. But I'll stop. Do you have any questions on anything I've mentioned so far?
No, it's a great stuff. In terms of this next slide, I actually find it interesting because we're getting to the nitty gritties in terms of how we actually turn this into an investable thesis. So why don't you keep going?
Okay, so if you were to flip to the next slide, which is on page 10, so this slide, what you see here is export volumes, right, broken down by EM region. And so kind of no surprise here. Earlier on so let's kind of go from the bottom, right? So Africa and Middle East kind of continues to be a bit of a basket case situation there. You have the OPEC plus countries holding back on oil output and on oil exports. So clearly, the exports coming out of Middle East and Africa remain somewhat depressed, right? CEE, which is Central and Eastern Europe. Well, these firms in Poland, Hungary, and Czech Republic are highly integrated into Western German, supply chains. And France is back in lockdown. Italy's back in lockdown. They can't get their vaccine kind of story sorted out here. So no surprise that you're not seeing stronger export volumes out of emerging Europe, although over the next few months, I expect this to change, and that's actually going to accelerate. But what's driven so far the export volumes from emerging markets has been LATAM and EM Asia, because EM Asia is very integrated into Chinese supply chains. And LATAM, well, that's where a lot of the copper and iron ore and commodities come from. And so now we're kind of seeing this shift where LATAM exports are starting to slow here because China's not importing as many commodities. And EM exports writ large continue to grow, but that's really being driven increasingly by EM Asia, by Thailand, by Taiwan, by Korea, because again, China is trying to drive ahead with this, technology advancement process, and for that, they're going to continue to need the tech that comes out of, Korea and Taiwan. And Thailand, and then also Japan, which isn't an EM, but that's also integrated into Chinese supply chains. And if you look, for example, over the last few months, like last month, at Japanese export volumes to China, they were growing at 50% year over year, 50%. So I think this kind of phrases or frames how you want to be allocated going forward is, EMs have had a pretty good run. EM Asia will likely continue to do well on the back of what's happening in China. And over the next few months, as Europe starts to recover from its COVID lockdowns and gets its house in order, as best as Europe ever gets its house in order, I think you'll start to see a bit of an acceleration here in CEE. So Czech, Hungarian, and Polish exports as well. And so that's kind of how I would look to allocate within an EM mandate here.
So in some extent, Aidan, aren't you kind of saying that the commodity trade has gotten ahead of itself and that we could be due for a pause?
Yeah, so that's exactly what I'm saying. And again, I don't want to sound too bearish where I'm calling for, a commodity bear market or anything like that. No, because I still think like, China's still importing a lot of commodities. It's just, less so than they were doing previously. And I mean, look at what copper is up year over year, or lumber is up year over year, right? Like it's just the pace of that growth is going to slow down now. So that's. Yep.
Sorry, I didn't mean to interrupt, but so I'm thinking about this. So you're saying that they've imported all the commodities, and now they're realizing that it's time to put those commodities to use, and that they're not going to be able to sell, as much stuff to the States in terms of actual goods. So they're going to do more investment, in more capex spending on their own side. And so you mentioned Japan. Is Japan potentially going to benefit a lot more? Is Korea going to benefit? Like, is that really the next part of the trade where you should be focusing?
Yeah, well, I mean, for the last year, we've been telling clients to belong, these EM Asia countries and Japan. And I think that continues to do well. I think Japan will continue to outperform. They have some institutional issues that they're working through right now, but they're going to continue to I think their export growth is going to continue. But I think, more of the out of consensus places to start to put capital, if you really want more of the juiced upside, is going to be in Europe, in Germany, and in Central and Eastern Europe. Because, under the surface, no one's really talked about this. Whenever people talk about the trade war, they really talk about US versus China. But Europe has been losing a trade war to Japan for the last few years. And you can see this in the currency dynamics, not just in euro yen, but if you look at, for example, euro CNY versus Japanese yen versus the CNY, because China is a major export market for both Japan and for Europe.
Right.
And German manufacturers compete with Japanese manufacturers. And over the last year, you've had a scenario where euro has been very strong, which has made European exporters less competitive. And the yen has been relatively weak versus the euro and CNY, which has made Japanese exporters much more competitive. And I think now you're starting to see a little bit of a shift where, the ECB is trying to weaken the euro. You're seeing some weakness at the margin. There's some dollar strength here developing as well. So look, I still think the entrenched trade is for EM Asia to outperform other areas in emerging markets.
Yeah.
Well, particularly LATAM, and for Japan to do well. But I think this unloved, CEE region in Europe, I think that's kind of it's like a spring that you just kind of push down, and it's just coiled and ready to pop as soon as conditions in Germany and the rest of the Eurozone loosen up. So does that help?
Yeah, that for sure. And so how would you express that trade? Like, would you be buying German stocks? And when you mention the other European countries that are EM kind of more competing on that, who are they, and what does expressing the trade look like in those countries?
Yeah, so you can buy you could do regional or country ETFs, which would give there's Taiwan, there's Korea, and realistically there's one company in each of those markets that really dominates, which I won't really talk about company specific stuff here, but in Europe, I think you can, like, the DAX has rallied a lot, and that still looks attractive. And actually, a market where I think is actually going to outperform a lot in Europe as well, which is, as strange as it is, I think it's going to be the Italian stock market. And I hesitated on adding the charts to this deck because I wasn't sure how much interest there would be in Europe here. But here's like this huge bull opportunity in Italian stocks that nobody's talking about, but I'll get into.
Let's go to it, because this is the kind of stuff that we love. Things that people aren't thinking about. What chart do I go to? Like, did you bring it or no?
No, I have another deck I can send. I have another presentation deck I can send. But here's the thing. So I'll go through the Europe.
I have the chart here, the FTSE.
Okay, so the ECB is expanding currently its PEP purchases, right? Pandemic Emergency Purchase Plan purchases, where it's essentially buying sovereign bonds in Europe without being limited to the capital key in Europe. So under previous periods, the ECB would have to buy sovereign bonds in Europe in proportion to the capital key, which meant that they would have to buy more core European government bonds. But under this pandemic program, that's no longer a constraint. They can buy, if they want to buy all Italian bonds 1 month, like they can go for it and do that. And so what's happening is Europe is in this liquidity trap where if you look at European M3 growth, so money supply growth in Europe, it's very, very strong, but there's actually like not much credit growth going on in Europe because that money is not translating or is not, being filtered through to the real economy. Banks, in short, are not lending it out. So why not? Why not? What are banks doing, and why is this bullish for Italian stocks specifically? So if you're a bank in the Eurozone, and you know that, look, economic conditions are pretty weak here. There's a lot of credit risks, but I have the ECB that's just buying government bonds hand over fist and is essentially buying bonds to keep German yields down and then buy Italian bonds to keep all the spreads down, right? Because what you want to do if you want to control yields and spreads is you're going to buy Germany, which is the most pristine kind of borrower in the Eurozone. So you're going to pin German yields to the floor, which is going to help limit, the absolute level of all the other bonds. And then you're going to go out and say, well, what is the worst issuer here? And it's Italy. And then so you're going to go and you're going to buy all the Italian bonds. And it's kind of like a sandwich where when you buy the Italian bonds and you price, you drop the Italian yields lower. Well, if you drop Italian yields lower, that must mean Spanish yields are going to fall, French yields are going to fall, Dutch yields are going to fall. So by just buying Germany and Italy, you're compressing the yields of overall European sovereigns. And so banks are basically not lending to the real economy. And I wish I'd sent you these charts, but if you look at, if you break down bank balance sheets or total assets by who they're lending to, you're seeing very strong growth in Germany, France, Italy, and Spain of bank lending to the government and to other financial institutions. In fact, in France, 55% of total assets are loans to the government and other banks. Okay. Right. And in Italy, it's growing as well. In Spain, it's gone from, call it 25% to 31% over the last few years. And so why would they do this? Well, it's kind of a mouthful, but I'll use Italian banks as an example. So if you're an Italian bank, the biggest proportion of your balance sheet is essentially the your holdings of Italian government bonds. And when you sell those government bonds to the ECB, you mark that profit at fair value through OCI, which is other comprehensive income, on your income statement. And if you look at Italian banks, whether it's Monte dei Paschi, whether it's Banco Popolare, UBI Banca, Unicredit, et cetera, that those Italian bonds at fair value through OCI, which I know is quite a mouthful, is between 100 and 180% of their tier one capital. So they're just like printing money off of selling these bonds to the ECB. So as long as the ECB continues with this PEP program, all they're doing is entrenching a liquidity trap that's going to be very good for the banks in Europe. And so this brings us back to equities, because if you're looking at, for example, the Euro Stoxx 50, banks are the largest chunk of that index, right? So you're benefiting the banks. And then as things open up and you improve the export outlook for places like the Netherlands and Germany, well, then you're also going to get an improvement in the outlook for the industrial firms in Europe. And again, that's another big chunk of the equity market in Europe. So, I don't have the charts, in
No,
the
that's
deck here,
okay.
but
No,
I've
that's all
tried to
right.
lay out, the story
But
of why
are you not worried about the spring,
the protests.
the protests and their potential election if Draghi doesn't end up, being able to hold he's got a minority government, doesn't he? Or he's cobbled together a government of some sort. I'm not sure. It's always changing there. It's tough to keep at track. So again, does this come back to the political risk? Does the political risk not scare you about the Italian?
Yeah, well, look, political risk in Italy is always a thing, right? Because the governments have a history of being short-lived because of the differences between the north and south and the difficulties governing there. And protests in spring and fall again are always an issue across the Eurozone because it gets too cold in the wintertime and too hot in the summertime to protest. Right? So look, it is, but at the same time, you follow the money, right? Which is the banks are printing cash because of the PEP program. And then as things open up and the euro, weakens versus the dollar here, you're going to get an improvement in the outlook for the industrials in Europe. So, I think it's a decent risk reward case there to be made.
Oh, that's a great trade. Actually, why don't we go backwards and why don't we tell us the other trades that you like, and then we'll work back on the slides. So, what other things, like when you're thinking about like what you're telling clients, like what are your themes that you like? Let's go like another one. Can you go backwards and then we'll go to the slides?
Yeah, and so is there any particular asset class that you like here?
No, we're looking to you. You tell us what you like best. The best risk-reward trades, and I always I'm a little partial to the ones that people are overlooking. It just kind of feels better when you grab one that's ahead of time. So, I'm good. A good trade is a good trade.
Yeah. So, look, I think the EM Asia versus LATAM one is a decent trade, particularly versus Brazil, Japan, Central and Eastern Europe, because like the prices just haven't recovered there. The sentiment's been pretty poor. The European equity trade as well. They've actually seen outflows of capital from there. So foreigners have been leaving the Eurozone equity market for really only the third time since the GFC. So the only time you've seen net outflows out of European equities by foreigners, so I'm looking at a current account basis here, is GFC, taper tantrum, and now. Okay. So just the sentiment's being pretty beat up, and I think you're going to see some improvement there. And then the other trade here too is like I'm actually very bullish on the dollar here.
Okay, why don't you walk us through? What slide should we go to?
That's music to my ears all of a sudden. Like I perked up.
Yeah. So on the dollar, particularly, I don't know if there's the slides here because it's more the U.S. reflation story that I'm really pointing to here. But I think the news that we've got from the Fed over the last 2 days has made me significantly more bullish on the dollar because what the Fed is. So the Fed came out and they didn't extend the SLR, right? The supplementary liquidity ratio exemptions for banks. So what that was in last year in March, you had equity sell-off, you had bond sell-off because the banks didn't want to use their balance sheet to warehouse these treasuries. So the Fed came out and said, okay, we're going to give you a 1-year extension that allows you to not have to hold capital against your treasury positions, right? So essentially, treasuries were as good as cash for U.S. banks. But now, as we've emerged from COVID, and there's a lot of reasons why this has been the case, but Elizabeth Warren wrote a letter to the Fed, essentially warning the Fed, don't extend the SLR exemptions for treasuries, because that would have allowed banks in the U.S. to pay dividends and buy back shares because they would have had a lot of free capital that they weren't having to hold against their treasury positions. So the Fed basically didn't extend that. But what the Fed has done recently is expand their reverse repo facility with all non-banks. Any large non-banks can now go to the Fed and pledge cash, which cash is abundant right now in the U.S. financial system, and get T-bills in return. And this was primarily directed at the money market mutual funds, because without going into too many of the weeds here, the expiry of the SLR exemption means that banks don't want to hold treasuries, and banks also don't want customer deposits because they have to hold capital against their customer deposits as well. So they don't want them. So what they're going to do is, incentivize depositors not to put the money with them. So the depositors are then going to go to the money market funds to hold their cash there. Well, the money market funds are ballooned with cash as well. And so what they're going to do is they're going to take this cash, give it to the Fed, get T-bills or repo in return. And so what you're going to see is the velocity of money in the US is going to essentially crater once this happens. You're going to have a base effect of spending, but once dollars are sitting with the Fed in this reverse repo account, like, they can't be lent out. They're sterilized, right? So what this does is it essentially puts a zero lower bound under the front end of the rates market in the US, which had been a big problem because front end rates in the US have been pushing towards the zero lower bound. So for example, if you were to pull up a chart of the US yield curve and you were just to graph it, over the last month, everybody is talking about the rise in long end rates, right? Where we've had, treasuries go from, past 150, past 170. But nobody's really been talking about the front end of the yield curve pushing down towards the zero lower bound. Well, now that the Fed's doing this reverse repo facility and has expanded that to 80 billion per counterparty, they're essentially creating a floor for the short end of rates. And so what's going to happen is they're going to have to expand this. But this is the first step to kind of tightening, right? Not tapering, but tightening reserves in the system. And so, I just think that there's just now this one less. If you think on balance here for the dollar, well, now you have higher treasury yields compared to essentially everywhere else in developed markets. So that should start sucking capital into the US. And it probably will once Japan comes out of their market holidays or their holidays at the end of March, beginning of April. And then you have money that's no longer absolutely free at the front end of the curve because the Fed's holding up rates there. So I actually think the trade here is a little bit more bullish dollar here. And so I don't have the charts on that, but that's the rationale behind that.
Okay, so Aidan, you're talking about the US dollar headed higher. What sort of time frame and how far do you think it might go?
So great question. So I think you're going to start to see that. Well, I mean, look, we've already seen it occur over the last few days. And what's interesting is you haven't seen it occur just in risk-off days, but today we had a pretty decent risk-on day when you look across, at least in the U.S. towards the close, and that the dollar was still kind of bid here. So I think you're going to get DXY, push above 94, 95 here. Because, yen, I think the path of least resistance is for yen to weaken here. And then I think also over the next few months, euro as well, as conditions improve in the US immediately. But let's not forget the 10-year treasury yields at 172. Like, if you're a Japanese investor, you're licking your lips here. And I think they're going to start piling in start April. So I think that trade's kind of already on, to be honest.
Okay. Well, you know what? The DXY at 95 plus is making Patrick really happy. So one of the things, though, as the U.S. dollar rallies, sometimes that's a problem for equities. And why don't you walk us through what you think is going to happen with equities, with the reflation trade, with it all?
Yeah. So for the last probably 6 months, we've seen inflation coming to the US, right? But the inflation we see puts the Fed in a tough spot because the inflation we see is not the good type of inflation. It's not demand pull inflation. It's cost push inflation. And what that's going to do is it's going to strain operating margins in the US, particularly in the small caps and in the value segments, which are the segments that have really rallied since October and November when we got the vaccine news. And I actually love this barbell where you go long large cap US tech and you go long commodity producers and materials, because I think that's a favorable kind of playbook here. Whether I'm right or wrong on reflation, I think those are going to end up being the best sectors. So what you see on page 12 is the Philly Fed survey of firms, where firms are saying, look, our prices paid, so the prices that we're paying for goods is skyrocketing here, and we're not able to increase prices that we receive commensurately. So there's this cost push inflation. And this is coming through from a few channels. So one place it's coming through is if you turn to the next page, page 13, you'll see this as well. And I think this is very important for equity investors as the story develops. So again, if you look at it from a more macro perspective, all of the increase that we've seen in CPI so far has been driven by this huge surge in producer prices. So firms are seeing their input costs rise, and they're trying to pass those input costs on to their consumers. But I think that that's going to be more difficult as time goes on, because I showed you that chart. I don't want to jump around too much, but I showed you that chart back on page 9, where I broke down U.S. consumer spending by product group. Like, if firms have had problems with their operating margins while durable goods consumption surged, what's going to happen when demand for durables starts to slow because we're, too busy going out for dinners and drinks to buy any more TVs and cars and RVs, right? So I think this cost push inflation is going to be more entrenched. And so this PPI CPI story is probably going to linger, but it's really, there's like two things that are driving this, right? So if you go to the next page, page 14, part of it has been this kind of weaker dollar, at least versus CNY, but also versus hard assets. So let's take a look at this, right? Like, most of what the US consumes isn't produced in America. It's produced outside of America. And largely, if you walk into a Walmart, most of the things in Walmart have a Made in China logo stuck to the bottom, right? Well, so look at this chart. On page 14, the dark blue line is all import prices, excluding food and energy, right? So kind of the core import prices. That's hugely surging, bigly surging, as a former president would say. And you have goods of Chinese origin, which is accelerating as well. And this is very important because, China has tended to be a source of disinflationary pressure for U.S. consumers, right? Because China's had very efficient supply chains. It's had an undervalued currency. It's had cheap wages. And so China has historically exported deflation or disinflation to America. But now that you've had the RMB remain bid and China's trying to lift their living standards by raising wages, and supply chains are shifting because of the trade war and for other reasons, you actually have this adding to cost push inflation in the US. So you have this import issue going. And then finally, if you were to go to page 15, you also have the fact that, look, commodity prices have been rallying in dollar terms as well. And while I think that the pace of commodity price appreciation slows, because they just can't keep going parabolic forever, it's still entrenched, because what you're seeing is all central banks are pinning rates towards zero, and all governments are spending money like there's no tomorrow. And so what does that mean? It means that fiat currencies are devaluing versus hard or scarce assets. And, this explains, Bitcoin and crypto. It explains a lot of these commodities as well. And so this is all adding to the cost push inflation in the good side of the US economy. And so everyone right now is piling into value and piling into small caps. And I'm actually a little bit concerned here, because if you go to the next page, page 16, look at operating margins for US firms, right? So here I break down operating margins by size. And so what you see is, as you go down in size from the S&P 100, which is large cap tech, to the 5, to the equal weight, to the small caps, the operating margins get structurally narrower and weaker. And so I can kind of hear, Kevin's voice in my head saying, well, hold on, Aidan, 1 minute here. Look at the margins pick up on the equal weight index. Like, isn't this speaking to an improvement as we escape COVID? And I would argue that no, this improvement in the equal weight S&P is driven by financials, but that is complete balance sheet gimmickry, which I also have the charts later on in this deck, and that's fake news. And so I actually like this barbell of being long the companies that have a history of innovation and compounding growth, i.e., the tech stocks and the growth stocks, and offsetting that with commodities and material stocks that should benefit whether I'm right and there's cost push or demand pull inflation. But let's kind of delve into this in a little bit more detail, because I know there's some hot takes, and Kevin's hair is probably on fire here.
I don't have any hair left to be on fire. But that's okay, and I love hearing the other side. I get stuff wrong all the time, so I love hearing them. So let's go through it here.
Okay, so if you go to page 17, okay, so let's look at retail sales, because in January, so February's retail sales were somewhat lackluster, but let's look at January and what drove retail sales, right? Essentially, it was housing that drove retail sales. It was all the goods associated with housing for the most part, right? Furniture, electronics, building materials, department stores when you furnish your house. So all of this led to the huge surge in retail sales. Now, well, let's look at the outlook here for housing when you have rates, at 172 on the 10 year as I sit here. If you go to the next page, the recovery in housing was very narrow. So what I'm showing you on this page is mortgage originations by credit score. Almost all of the mortgages that have been issued over the last year have been to only the most pristine borrowers in the US, those borrowers with a 760 plus credit rating. Well, what's going to happen now when, we open up, and if the labor market takes longer to recover, you have yield stuck here, it's going to just it's going to be much tougher to get a broad-based recovery in the housing market. And I think you're starting to see this already, this worry with rising yields on the very next page, page 19. Right? Because so on this chart, I show you, the 10-year yield, which is tied to 30-year fixed rate mortgages, and that has started to accelerate here at a time when the spread between those two is essentially at, more or less an all-time low, like at least a post-GFC low, let's call it, right? So essentially, there's just less space here for margin for yield compression between these two lines. And so as you get better inflation dynamics come out over the next few months, because of just, purely base effects, if nothing else, where oil's not negative anymore, right? And we're going to go from lockdown to open up. You're going to get this increase in inflation, which may put upward pressure on the long end of the yield curve. And that's going to, push mortgage rates higher as well. And so this is the point where things get a lot, somewhat contentious, because the pushback I get is, well, Aidan, but what about the huge savings glut that's, sitting in because of the stimulus payments and in people's bank account? Isn't that going to facilitate a broader pickup in spending? And I look, if you look under the surface, it seems to be a much more complicated picture. So if you were to, on the next slide, you can kind of see this play out. If there's any questions on that,
No, keep going. This is great stuff.
Okay, so here on this page, I show you a chart that maybe you've seen before, but it breaks down stimulus payment use by household income. And so this was how all the stimulus payments were used through July 2020. And that was, when the last stimulus was passed before the one in after the election. So everyone talks about the savings glut. Well, savings, which is that green section, that increases as income goes up. But that's what people, wealthy people save more anyway, right? So you just expect that to be the case. But for the majority of households in the US, and this is where I tie into that fake news number, I start getting into that fake news bank number, the majority of stimulus payment has just been spent on food, health, beauty, and household, i.e. basic necessities, and paying down debt. Because if you're a reasonable person and I take away your job and I say, I'm going to give you a one-off stimulus payment, well, what are you going to do with that, right? You're going to try to save what you can, but you're going to pay down your high interest, credit card debt, and you're going to, hunker down and buy basic necessities. And that's what's occurred. And so what I look for a broader cyclical, a longer cyclical recovery is actually on the very next page, page 21, which is, I think, the employment situation in America has to improve much faster. And I think that that's going to be harder to achieve given the margin pressure I've talked about, but also given the higher interest rates. So this chart's kind of interesting, right? Because the US, so on this chart, we have initial jobless claims, and then you have the red line, which is non-farm payrolls. So non-farm payrolls have had a pretty decent comeback from their COVID lows. But under the surface, there's a lot of churn. So this week, there was another 770,000 job losses. And so what I do is I compare job losses currently with what we saw. I have it circled there in 2009, which was the GFC. So in the GFC, there was a 6-week period between early March 2009 and mid-April, where America lost $680,000 jobs per week for 6 weeks. But then it got dramatically better, and you can see the initial jobless claims steadily fell. Well, every week since COVID has begun, we've had more jobless claims than the worst of the GFC. So my outlook for consumption in the US is a little bit more muted, at least in the goods side, because I look and I say, well, look, goods consumption's already surged. Households have been not really stockpiling savings, but just using it to pay down debt and for basic necessities. And the longer it takes for a recovery in the labor market, I think it portends a longer recovery in, it takes a longer time to get a more durable cyclical recovery. And so that's why I kind of like that barbell that I've talked about, which I'll get into. So does that make sense?
Yeah. So almost, is it a return to what we saw like last fall?
Well, to 2019, right?
No, 2020, when we saw, like basically the little growth, people, the bond market rallying, or not rallying, but at least rates are low, and people reaching for growth stocks because there's very little growth in the economy, and it almost feels to me like that it's you're almost calling for return of that kind of pre-opening trade, like before we got excited about the opening, before we started discounting it. You're almost saying we're going to return to that scenario. Am I wrong?
No, I think you're right in the sense I like that barbell approach. But actually, what I'm going to do is I'm going to do you one better. And as I go on in the deck, we've actually done a lot of work to quantify in exactly what scenarios growth and value outperform each other. And so I'm going to kind of provide that as what indicators to watch to see when this shift starts to shift back to growth. But when it comes to growth and value and the rising rates, the conventional wisdom is that, look, well, large cap tech is the most exposed because they're a long duration asset, and and their valuations are high, and that's kind of true. So when you look at this chart on page 30, I decompose S&P 500 total returns, and what you see is most of the increase has actually come from, or a large chunk has come from, buybacks and also multiple expansion, whereas EPS growth has been rather narrow, particularly once you adjust it for buybacks. And so as you raise rates, what typically happens is what's on page 31, right? Which is, so what I show you on page 31 is what happens when the Fed is increasing rates. And the Fed's not increasing, but the market's doing the tightening for them because you have, 10-year yields rising. So what you typically see is trailing, so PE ratios when the Fed is hiking tend to contract, right? Because you're increasing your discount rate. But EPS accelerates because the Fed is tightening, usually when conditions are very good and there's very strong demand pull inflation. Well, that's not actually the case right now. You're having just the onset of kind of this recovery in the economy, and the market's getting too far ahead of itself, pricing in, higher, longer end yields, and that's going to start to sap economic activity and rates and growth. And so I actually see value stocks more vulnerable to this than growth stocks for what you see on the very next page, page 32. Because look, the big cap growth stocks are going to continue to compound, innovate and compound earnings. But when you look at what's priced in here, so what I'm showing you on this chart is trailing versus current year EPS for the S&P, for the S&P X, the FangMan stocks, which are the tech high flyers, and then on an equal weight basis here, right? So, look at the green line, which is the two green lines, which are trailing versus current year EPS expectations for the equal weight S&P 500. Like the market's basically saying we're going to go back to essentially pre-COVID level, pre-COVID levels of EPS here, despite the massive debt levels, despite the debt service cost, despite the uneven opening up of the economy. And so I think that these earnings are what's baked in here is kind of set to disappoint. And so I think it continues for the next few months because we're going to get this reopening kind of surge. But what I try to do on the next 2 slides is lay out exactly how I think investors should think about asset allocation between growth and value over the next few months. So what we've done is we've done a lot of work to think, okay, well, look, value stocks tend to outperform when there's a fast pace of growth and inflation, because that's when factories are doing well. That's when people are buying cars. Like that's when, the old school sectors of the economy do well. So what we've done is we've quantified this. We've gone back to 1998. And we've looked at break-even inflation and world PMIs. And the average of those are 1.9% for break-even inflation, and for world PMIs, it's 52. And so what you see on this chart is that in only one period does value outperform growth. And that is when that first scenario plays out. You have break-even inflation above 1.9% and world PMIs above 52. In every other epoch of growth and inflation, growth outperforms value, right? And so this might be a little bit, this chart it's maybe not as clear in terms of looking at what that return outlook would look like. So if you go to the last page 34 here, I'll show it to you. So what this chart shows you is the cumulative performance of the S&P 500 growth and value, and then of this growth and value strategy where you allocate to growth or value every month based on where break-even inflation and world PMIs are. And so if everyone's looking at growth stocks and thinking growth has performed well, I would actually say, look at this green line. Our model of allocating to growth and value based on break-even inflation and world PMIs makes growth stocks look like value stocks for the last decade. You know what I mean?
Wow.
We just totally destroy them.
That's
awesome.
That's a great little system. I really like that, Aidan. That's really well done.
Yeah.
That's awesome. So listen, a great chart book. So everyone, I hope you've signed up for our newsletter. Our email that Leena sends out every week, because we'll have a link. But if you haven't and you want this, we'll make sure that we put a tweet out with the actual link to it, because sometimes we get decks that are, things that you don't need to look at, but this is definitely one of them where you definitely want to have a look at it. So Aidan, why don't you tell people a little bit more about yourself, your firm, and where they can find you?
Sure. So I run the Global Macro and Strategy group at Pavilion Global Markets. We provide financial services to institutional investors. So global macro research, agency only, best execution trading for global equities, ETFs, and fixed income, and transition management services for institutional asset managers who use sub-advisors or sub-managers. And so you can get to me, I think my email's on the front of the deck, but you can reach out to me on Twitter. You can send me an email. We aim to respond, within the day or within, 2 days. And essentially what we do is we just try to put out concise, actionable research for institutional investors and asset allocators.
It's terrific. Well, thank you very much for coming on the show. We look forward to you being in lockdown, being allowed out after 8 p.m. again. I had no idea. Patrick and I and Leena, we always complain about what it's like here, but we had no idea. At least I don't know. I didn't have any idea that Quebec was so strict. So we look forward to coming and this all being over, and we'll come to the wonderful city of Montreal and have some drinks with you.
Perfect. I look forward to it. Thanks, guys.
Thanks again.
Right, thanks, Aidan. Joining us now is Morris Sachs, a good friend of the show. How you doing, Morris?
Good. It's Friday and the market closes in about an hour, right?
Yeah. We're doing this. So I'm going to jump in here, Patrick. It's Kev. Morris, you were expecting you actually canceled on us a couple of weeks ago. And so he cancels on us, which I'm like, no problem. He's got things to do or whatever. And it just I was actually a little bit worried about you. I was worried maybe something's up and stuff like that. And then I'm listening to his podcast. Morris cheats on us, Patrick. He has his own podcast.
I'm not surprised.
Yeah. And
we have open relationships here.
That's right. We have an open relationship with Morris as well. And I'm listening to his podcast, and he starts fessing up that he basically canceled on us to go mountain bike riding, or maybe was it mountain bike or was it road riding?
I think it was a mountain bike ride.
Yeah. So, pro tip:
Yeah.
you know what? When you cancel on it, you don't actually go and announce that you cheated on me on your podcast, because I might listen.
Yeah. Well, I've been thinking about that, and I was noticing. So the other day, I was watching Becky Quick interview James Grant from Grant Chitcher, and I happen to think the guy's terrific, right?
Yeah.
And so they're talking for a minute or two, and then Becky Quick's like, "Okay, I got time for one more question," and she's rushing the guy, and I'm thinking, if I ever get to be a famous podcaster or market commentator, I'm only going to give interviews to either you two guys or my friend Liam Allen. None of this showing up and hearing about how they got to cut to a scene of pulling a cat out of a tree or something like that.
It's actually really hard. Like, I've done radio, and there's these blocks, and you think that the block sounds like there's tons of time, but it's not. You have to like bang, 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 bang. Like, you have to you have to say your point and get out of the way.
Yeah. Well, anyway, it was.
Anyway, so was the bike ride worth it? Is what I want to know.
Well, especially now that I'm here and I'm doing my penance. Yeah, the bike ride is definitely worth it.
I'm just pulling your leg, and I told you at the time. I said no problem at all. Feel free to cancel on us at any time, especially for something as important as a bike ride. I was saying that here up in Canada, numerous times, if someone's going to the cottage early or something like that, if it's nice weather, we always cancel on one another. So I have no problem with it at all.
That's good to know. It's sort of payback for you guys always cracking open a beer before your show and then never offering the guests any beer.
Well, unfortunately, we don't do it together, although we're looking forward to being able to do it together. So now let's talk about the markets, because there's a lot going on. One of the things I know that you're been leaning a little bit more towards, the market is getting overly excited about the strength of the economy coming out of this, right?
Yes.
And what I want to know is we've almost, to me, it almost feels like hysteria on the bond short side. I did the kind of an analysis today, and I realized that when you look at the Bloomberg 20 or long bond total return index, we're more oversold than any point, going back to the whole index in 1998. This is the most oversold we've ever been. I'm wondering, do you feel like we're close? And do you feel what might be the catalyst that will wake people up?
Well, first, to your point about the, I don't know if you used the word euphoria, but excitement. Yeah. There were two charts I saw this morning, and I had planned on sending them over to Leena, but then I realized this is a podcast, so not many people can see these charts. But to explain them is, one of them is it shows the percentage of people that are buying houses sight unseen. Yeah. And it's like 60%. And that's up from 40% a year ago. And, you think about that for a minute. And for most people, their house is the single biggest asset they're going to buy, right?
Right.
And so you got a bunch of these people buying the house sight unseen. If I don't know what a panic, it looks like it's, this has got to be it, right? Just people grabbing stuff. And so the other thing I wanted to comment on was I saw the amount of currency, large bills in circulation has shot up back to the high it was during the financial crisis. And if you look back in history, I know you guys like to do this day in market history kind of thing. Yeah. When you go into the histories of banking crises, that's what happens is people grab a huge amount of physical currency because they feel more comfortable holding it. So those two things have kind of indicated to me that there's a lot of anxiety and people just sort of grabbing stuff. And as far as the rate markets go, because I'm guessing that's probably what your real question was.
Right.
I'm going to go out on a limb and say that I think that if you do get the 10-year notes above 2%, the Fed's going to come in and talk about the fact that they think the jump in rates is hurting the housing market, and you might start to get some Operation Twist. So,
so you think we're still another 20 basis points away from that?
Well, what I'm saying specifically is if we get there, then you will get that out of the Fed.
And will that be enough? Will they be able to jawbone it without actually doing anything?
Yeah, I think they'll be able to do that because if as you've said, I feel like once we get past the sugar high, the economy's going back south. You look at what's going on in Europe and even in your fair country to some extent, they've bungled the vaccine. As much as everybody hated Donald J. Trump, it seems like he got the thing moving in the right direction, and then Biden's kicked it in the rear end and really gotten it moving. Italy has got more lockdowns. Germany's got trouble. So around the world, at least in the European sector, you're not going to get a lot of growth. I know up in Canada, it just sounds like what was once the adult in the room seems to have swapped places. So I think we're kind of towards the back end of the increase in interest rates for the time being. I'm not the big inflationista, but I'm starting to change in that I've heard of three things here recently. A buddy of mine owns a restaurant, and I won't say the city, and he owns three of them actually. And the guy is a hardworking, smart guy, and they've been scratching and clawing to keep their head above water. And I spoke to him yesterday. He now, thanks to the PPP, has $1 million sitting in his various bank checking accounts for his businesses. The guy's never seen $1 million in his life, and it's sitting in his bank account. So
wait, I don't understand that. They've actually sent him money?
Well, he's applied for the PPP loans.
Oh, it's a loan. Okay. And then it gets forgiven if he keeps it.
A lot of it is, right.
Yeah.
And then there's more coming down the pipe with restaurants, with the 1.9 trillion, whatever they call this new act that just got passed.
CARES, isn't it? Isn't this one
CARES? I don't know.
I'm not sure either.
So there's money that wasn't there 3 months ago. Okay.
Right.
Secondly, my a good friend is in the business of doing asphalt driveways for people. And he said he's back at work now, and no one's asking about the price. They're just asking how soon can they get the work done.
Right.
And that's a very price sensitive type thing. And finally, I need to be a little bit vague about this, but I'm aware of people in sort of the automotive sector, and they're getting word from their equipment, the OEM type stuff, that there's supply hiccups and don't expect them to be resolved anytime soon.
Right.
So, before I was kind of betwixt and between with the, is inflation going to pick up because of the huge M1 growth, or is it the Lacey Hunt, we're, borrowing against the future,
right?
And money supply.
So you're coming to our side.
I'm 60-40.
Okay.
But to square the circle or finish the equation, so how does that fit with me telling you I think the Fed's going to come in? Well, this is kind of, I guess, the inflation part. If they come in, let's say the market tests them, which the market does like to do. We're experiencing it now, right?
Right, exactly.
So let's say they take the 10-year note back to 2%, which is only 27 basis points from here. And the Fed comes in and does sort of the Operation Twist-ish thing, whatever you call it.
Yeah.
Well, then I think that will be effective, and then the U.S. dollar is going to head south.
And that's going to be inflationary.
That would be the inflationary. And it's inflationary, but it's also good for the economy. But
Okay.
So that's kind of
So you're almost like you're saying that we're closer maybe to a yield curve control light, no YCC light, or at the first stages of it, like maybe not even like yield curve control, maybe just like the twist operating different parts of the curve, and then you would argue that therefore then sows the seeds and gets the inflation going even more.
Yeah. The reason I'm sorry to be so long-winded here, but I haven't had a chance to.
No, that's good.
So, there's that great economic thought experiment where they say, you come and the government pays you to dig a hole in your backyard.
Yeah.
And they pay you, and then they pay me to fill the hole back in that you just dug. Okay. And economists would say, well, that's GDP, right?
Some would. It is GDP. Whether I'll give you my theory after. I'll let you finish. Sorry, go ahead.
Oh, good, because I'm seeing as you're a CFA, I thought you might be able to answer this question for me. So in that, I had asked economists, how does that work? Because you don't really create anything. He said the thing about the GDP equation is it doesn't take into account like a balance sheet. So the government is spending money to create this, right? So just before I get your take on it, the question for me becomes, we've just come out of a, call it a 6-month, maybe longer lockdown, where the government has filled the hole of what, but it was a real loss, right? Yeah. And so that's where, when they talk about the 10% GDP growth we're going to see, I don't really care about that because it's not that effective. It's in some ways
creating real wealth.
Isn't it a lot different than a hurricane comes through and takes out the state of Florida, and then they rebuild it? So that's kind of why I get conflicted between the inflation and then the slow growth. And maybe that's just stagflation is where we're going to end up.
Well, for me, so that what you're talking about is the broken window fallacy, whereas like you break a window and then it creates all this economic supposed, activity to fix the window and stuff like that. But at the end of the day, you're no further ahead. You're just fixed a window that someone else broke, right? Just much like you're digging a hole and then filling it up. And this was always been my problem with Paul Krugman. Paul Krugman is a big adherent to this, like as long as we're getting people to do something, it's beneficial, and I just call bullshit on that. Like it's a problem. And how I square this, Morris, is that everyone always asks me about MMT, and I always say, well, the government can fill a lot of the hole that we have previously not understood through fiscal stimulus. And then they say, but wait, it depends on what they do. And I completely agree that when they go and just give money to people to stay at home, it's not going to productive use. So what I argue is that means, therefore, the economy will hit the real resource, a band or the point, meaning that we'll get inflation quicker than if we actually were investing, meaning that you were actually doing something productive with it. And that's my big problem with this whole thing is that, here in Canada, Prime Minister Trudeau, he said, don't do any spending that's not permanent. And I said, yeah, I get it. We need to help the people that are actually having problems, and I get that. But at the same time, we need to do permanent spending. We need to do investment in infrastructure. And actually, this is my big problem, is that I'm worried that we're going to come out on the other side of this, and everyone is going to stop spending because we're going to get the deficit hawks back. And so all we're going to have done is basically give out money that never went to productive use. But anyways, I'm getting off at the point.
No,
that's my rambling. Actually, I really want to ask you though.
Yeah.
Can you put your bond hat back on? Put yourself back on your seat, at the desk. Given this belief, what part of the curve looks interesting? Do you have any trades that you would be looking at, and how would you be expressing your view?
Oh,
if I put you too much of a spot.
No, that's fine. I think what I would be doing right now, and this is going to be a very vague answer, but I would be looking at sort of the carry and roll down trades, and not having
explain that to people.
Okay, so you have the yield curve, and by the way, when I tried to do this on my other podcast, Liam got hate mail. So I'm staring at my Bloomberg now. So the 2-year note yields, call it 14.5 basis points.
Right.
And the long bond is 2.45. So that's, what's that, 230 basis points with the spread
Give or
between the
take.
two? Okay. So that's what we call right now the shape of the yield curve, 230 basis points. So along that yield curve, you have different issues. You've got the 2-year, the 3-year, the 5-year, 7-year, 10-year, 20-year, 30-year.
Right.
And so what I would do is break it down into sectors. So maybe 0 to 3 years, 3s to 5s, 5s to 10s, and then out past the 10s. And I would look at the shape of that curve, and then I would try and figure out what part of that curve showed me how the quickest move as the calendar turned. So for instance, if I bought a security and I came back 6 months from now, it's 6 months closer to maturity, right? So as the yield curve is steep, the yield should drop because it has less time.
Yeah.
So what I would be looking for is those issues which looked like they had the biggest roll down,
Right.
is what we call that.
Yep.
And then I would look at the carry, which is the cost of the money I would need to borrow to buy the security.
Okay.
And right now, the cost of money, I guess, overnight is, call it zero for lack of it. So if I bought a 10-year note, and let's just pretend the 10-year note finances at zero for a minute. I know that may not be the case, but let's just say it's zero. And the 10-year note yields 173. Every day I'm earning 173 basis points of positive carry.
Right.
And so what is that? So as you know, 1 basis point per day per million is like 27.8 cents.
Yep.
So all of a sudden, you start collecting these small amounts of money. And what I would try and do is this too technical for you?
No, not at all.
No.
Not at all.
I mean, I know.
No, so
like
you look for steep. You look for steep parts of the curve.
Where I could buy something.
Yeah.
Okay. And then depending on whether I felt we were towards the high end of the rate structure, I might just buy that and own it. Or if I was worried about the shape or where rates were going, I might look for something that didn't roll and carry as well, and I would short that.
And so you could also do this in the Eurodollar market, right? Because it's pretty liquid all the way out. You could go look for specific contracts that are just, you feel that absent anything happening, it'll roll down quicker, right?
Yes,
or
absolutely.
decay upward,
Yeah. So I think truthfully, the Eurodollar probably for most people would be the simplest way to do it.
Right.
The reason there's a reason I don't have the answer to your question specifically on my fingertips is because I have desperately been trying not to stare at this stuff all day. I mean,
you don't want to start. You don't want to go down that rabbit hole, and all of a sudden, next thing you know, you're tossing around your 5,000 lots of EDs again, right? Like
I don't know if you've noticed this. So I for an individual, I tend to trade rather large positions. And so I was rolling some contracts, option contracts. And I've discovered now, being a retail guy, but trading more institutional size, this algorithm stuff is a total screw job to Joe Public. And my example is this. I was trying to sell a call at $1. Okay. So I put in like a 500 lot at $1, and it's 95 bid.
Okay.
The next thing I know, there's a bunch of trades at 99 cents. Now,
they're running ahead of you. Yeah, exactly.
Yeah, but I can't put an order in at 99 cents. I can only put them in lots of a nickel. So what these schmoes do is they'll sell 10, 20, 30 contracts in front of me, okay?
Yep.
Figuring if the market turns, they can lose a penny, right?
Yep.
And if I get frustrated and hit the bid, they just made, and
you know, it's really cute watching the big institutional guy that was tossing it around all of a sudden waking up to what we've all been experiencing with the HFTs and all these guys.
You know, I can't wait to be at a cocktail party where Ken Griffin goes, "We're liquidity providers." I'm like, "Fuck you, Mister $220 million condo." You know, I people who provide liquidity don't make that kind of money. People who import rum in the prohibition, that's the kind of money they make. Sorry.
No,
hey,
that's
so
awesome.
Can I ask you guys something?
Yeah, sure, go ahead.
Sorry. I guess we've taken the professionalism down a notch.
Yeah,
I'm sorry,
yeah.
but I just feel too comfortable with you guys. So as you know, from time to time, I find myself being the grouchy old man yelling at clouds. I think you said, or I like to say, keep off the grass. Have you seen this thing with the Goldman analysts complaining about they having to work too hard?
But you know what the funniest part about it is? There's only 13 of them, and like it was 78% of them answered that. So there's no anonymity. Like, I can't say the word, but like they're not anonymous anymore when they all answer one way.
I mean,
there's only 13 of them.
You know, I don't know whether to laugh or cry. I mean, you know, think of this. Okay. If you're an analyst for Goldman Sachs, okay, and you're there 10 years, you're making between $500,000 and $1 million.
Yeah,
probably. Okay. And I want to point out for Leena's benefit, this is US dollars, not Canadian dollars. She always told me compensation is mentioned in US dollars. Sorry, I'll try and straighten up here. But the thing about the money with the Goldman analysts is, you tell me another job where you can put no capital on the line, right? You can have a bachelor's degree and a 1-year master's, right? And you can make that kind of money.
Yeah. The reality is that there's a million other kids that'll take their spots in a heartbeat.
I don't know. Patrick, you and I don't chat much, but your background, I mean, when you were young, what kind of hours were you putting in?
What do you mean? He puts in those hours today.
Yeah, I still work my ass off, but you know, I know, like, I mean, when you're in the trenches and you're basically trying to make a name for yourself and stuff, you put in the long hours. It's like putting in 60 hours a week. Actually, I haven't really stopped doing that, to be honest. Like,
Patrick is the hardest working guy in our industry, and I'm not kidding when I say that.
Good.
Stop teasing, but no, but you know what? I mean, I look forward to the day when I don't work as hard, but you know, I can just have a few beers along the way.
Well, I'm sympathetic because I probably, you know, people say, "What do you do?" And I say, "Well, I'm retired." And like, "Oh, what do you so what do you do during the day?" I'm like, "Well, I'm working on this, I'm working on that. I'm probably put in 40, 50 hours a week." But that to me feels retired. And but by the way, I mean, I guess it's retired because it's my choice, right? Yeah. I don't have to do it. But, you know, I read a ton of research. I don't read that Canadian guy anymore. He jumped the shark. And so
he's not talking about me, by the way. Although sometimes I worry.
I'm talking about the Canadian strategist economist who likes to think he's a strategist. I don't like saying their name. I'm sorry.
Okay.
I'll move along.
We're gonna move on. Okay, so listen, I have a question to ask you, and I promised that we were gonna talk about this because I thought it was so wise when you said it, and Liam, he didn't actually talk to you enough about it, and I thought that I should follow up. So you were mentioning on that other podcast that you guys do, which is, by the way, give us the name while we're here. You should know the name of your podcast, Morris.
Inside Baseball with Old Chestnut. Thank you.
Okay.
Okay.
So 2
Chestnut.
pro tips for good old Morris today from Kevin. Okay, know the name of your podcast and don't announce that you're cheating and you've canceled on the podcast on your other podcast kind of hosts. Okay, listen. So on that podcast, you mentioned something about the effect that you think that if you don't have high conviction of the trade, you shouldn't have it on.
Yes.
And
Yes.
I want to talk about that and flesh that out because I think that there was way more wisdom in there than it might seem at first blush.
Okay. Well, I've had the benefit of not just being a trader, but I managed a lot of traders.
Right.
And so you're sitting in a room and there's always some guy making a bunch of money and always some guy losing and people screaming. And there's just this urge to be active.
Okay.
And, there's that saying about, first of all, do no harm.
Yeah.
And as a trader, as you guys both know, professional traders, you have limited resources, whether it's your time, whether it's your capital, whether it's your balance sheet, whether it's your value at risk. And so what I found was that as the department manager, I wanted to make sure that we had the group's assets deployed as efficiently as possible. And the best way to do that was to make sure that every person working for me had just the highest conviction trades on.
Right.
Now, I know you had mentioned you have a friend or know someone that likes to have a tiny bit of something on
to watch the spread. Yeah.
Yeah. That's if that's his style, that's great. But to me, I just like to be laser focused on the best stuff. And, there's enough things now with the technology that you can put up a little algorithm or something to alert you to when something gets interesting or something. But you think about how hard it is. And one of the things that you had said, which I've always commented on, which resonated, was, it's the making money that's the hard part, right?
Yeah.
And that's what we're supposed to focus on. I think what I found in my travels is you get a lot of people who love to pontificate and give you their opinions and their thoughts. And I think that's fine, but ultimately you eat what you kill.
Right.
And so, if you had that matrix of right for the right reasons, right for the wrong reasons, wrong for the right reasons, and wrong for the wrong reasons,
yeah.
Right? I mean, I'd be happy to be right for the wrong reasons. Who cares? I mean,
it's like that line that I use often is like, some of us were lucky enough to be born smart, and some of us were smart enough to be born lucky.
Yeah.
Right? Because you'd rather be lucky than smart.
Yeah.
So now, since turnabout is fair play.
Wait, before you do that, actually, I think there's a whole element that you didn't go on about. You mentioned is that when you put on a position that isn't, for example, your high conviction trade, and then it starts to go against you, you end up not having the, you either from a mental point of view, you're not ready for when the opportunities do arise, or from a capital point of view. And it ends up being the opportunity cost that's coming up in the future that is more important than what you're doing today. And that's the part that I'd like to talk about, because I think that actually is way more beneficial than people realize. It's that old saying that cash has optionality to it, right?
That's the Warren Buffett thing.
Right.
Yeah.
So why don't you talk a little bit about that?
Well, if you have a marginal trade on, and Dennis Gartman, who I think you guys interviewed.
Yes. Yep. He's a great guy.
Yeah. I'm very fond of him. He and I go way back. I was client number 8 or something.
Really?
Like that.
Oh, I didn't know that. That's awesome.
Yeah. And by the way, I took a lot of stick in my on the desk, because he had this way of measuring his risk in units.
Yep.
Like he had 1 unit, 2 unit,
yeah.
and then one day he had 12 units. And I said, Dennis, I just got to tell you, mathematically, I can't prove it to you, but you can't have 12 units. It's just if one unit means something, you can't have. Well, anyway,
Yeah.
I'm sorry, I'm drifting. He talked about mental capital. Okay?
Right. Okay. Yeah.
So first of all, you got a trade that you're not in love with. You're spending time looking at it, and you're probably losing some money. And it's not typical for a guy to say, this is distracting me, I'm going to get out and cut the loss. They'll start adding to it,
Right.
which is, that saying, if you find yourself digging a hole, stop digging. They don't do that. And I think the best example for the investor who might be listening is a situation like, let's say they have a portfolio of 30% stocks, 30% bonds, and 40% cash. But the cash they put into some, short-term high yield thing.
Right.
Well, we all know that if something really weird happens and you need that cash, that short-term high yield situation is not, you won't be able to get the money out.
Right.
And I don't know that that's exactly what you're talking about with the no marginal trades, but to me, it's in the same ballpark. Keeping your powder dry,
right,
for the moment that you want to be in.
So I have a question for you with people that use leverage. Like, so for me, I can use a lot of leverage. I'm trading my own account and I can go up and down. Did you find that often people would be just like right at the edge, and therefore they wouldn't be differentiating their bet size? Like, it wouldn't be like, it's summer, there's less going on. They would still be trading just as big as if there was a great opportunity. Almost like a blackjack player, like the blackjack you're supposed to, if someone who's trying to win in blackjack varies their bet size based upon how many large cards there are still in the deck,
yes,
right?
Yes. See, the reason why those people do that, and my answer to you is no, traders don't do that, is because those guys at the blackjack table are playing with their own money. So basically, the bulk of proprietary traders are working that option, meaning if they hit it out of the park, they get paid a huge cut.
Right.
And in most instances, they don't have their own money up, or they have a small amount of money up, or they may have a clawback against the prior year.
Right.
But generally, guys are, at their risk.
Because it seems to me that varying your bet size when you're dealing in a leverage situation, like as a professional trader, is the part that a lot of people are missing. And
I was going to say, so we ran, I would say infinite leverage, although that's a mild exaggeration, but we could easily run 100 to 1 on our stuff. So what we would do would be, we would try and take a look at if we had some sort of trade that we would consider to be a mean reversion, meaning it's short-term out of whack and there's a catalyst to bring it back to fair value. We would try and estimate how far we thought it could get away from fair value, and then size our position according to that.
Right.
So I think inherent in that is, because that was a more of an analog decision, right? You kind of visceral. How far do you think it can go?
Yeah, which you don't know, obviously.
Yeah. So basically, you're taking your own view of the volatility in the market, and so I guess the answer for me and my guys we would vary the size based on maybe.
But you're varying the size there based upon the risk. There's also an element of basing it upon the return, meaning that if you'd gone and there's nothing going on, instead, and this is what I found, is that often, like, let's just take the risk arb guys. Arb guys sitting there trading, deal merger arbs, right? And so they'll go and they basically are always fully invested, and they'll always be right up against the line.
Yeah.
And the reality is that when the merger arb is trading, like at an annualized 5%, let's just say 5%, and then there's the chance of something going wrong, you should be doing less of it. And then when it's trading at, 25% because the world's coming apart, and yet there's all these great deals that are just falling all over themselves, they should be doing more. And too often, the people, you end up not having the powder to buy it when you actually should be buying it, right? Because you bought it earlier, which goes back to my point that you said about the marginal trades. Yes. Don't do the marginal trades.
So if you look at who like the really big winners are, obviously Warren Buffett gets to be the first guy because been doing it forever, was one of the first guys to enunciate that concept and sits on a ton of cash. Yeah. Then you look at Seth Klarman. He's a guy that is a very highly respected hedge fund manager, typically runs a very high percentage of cash. Okay. You look at Howard Marks, who I think highly of. I haven't looked at his analytics, but if you read his reports, he talks very much about, knowing when to be risk aggressive and knowing when to be risk averse. Yeah. So I think to your point, if this is what you're implying is, there's a lot of logic to not being full bore all the time. It just doesn't make any sense.
Yeah. Well, I just thought when you said that about taking off your marginal trades, it kind of, to me, it all blended into the same kind of, logic-based things. And I was like, oh yeah, that makes tons of sense that you shouldn't be, not only should you not be doing your kind of marginal trades, you should be doing less when there's less opportunities and more when there's more. And unfortunately, human beings just aren't like that. They just, as you say, like they're always, full tilt.
So one of my good friends, in fact, the man who introduced me to your blog, I don't think he wants me to use his name, but he'll know I'm talking about him. He likes to think about things, he says, as pistachio nuts.
Okay.
So that way, okay. So if, let's say, 10 years ago, they invented something that they invented the pistachio nut. And it traded for $1, then it went to $10, then it went to $100, then it went to $1,000. And then all of a sudden people start talking about it.
Right.
And then it went from 1,000 to 5,000. Now, let's say, for instance, that pistachio nut has gone from 5,000, it's up 10 times to 50,000.
I don't know what you could be talking about, but anyways, go on.
Well, I wasn't going to bring this up just per se, but I think this does fold into the logic of what we're talking about now, right? So if you bought this thing at 5,000 and it's gone up 10 times, right? I don't know, between you, me, and Patrick, we got to have close to 100 years of trading experience.
Okay.
Yeah. How many times have you bought something and it's gone up 10 times?
Well, not enough is my answer.
It's
it doesn't happen all the time, for sure, right?
Okay. So, and let's say you found something and it went up 10 times. Yeah. You're going to keep it?
Well, yeah.
Paper, you don't get rich off of paper profits. You have to take the profits at some point to make it real, right?
Yeah, and so that's why what perplexes me in this scheme we're in now is if you bought it at 5,000 and it went to 50,000, made 10 times, right? And the guys tell you it's going to go from 50,000 to 100,000.
Yeah.
So now all you got left is one more time, right?
One more turn. Yeah.
I don't.
Yeah. I mean, I don't know. You know what? I hear you. It's just
okay. I know. I can tell by the look on your face. I'm sorry. I'm sorry.
How
I
about
do
we
like
talk
pistachio
about
nuts.
biking or Okay, so I did want to ask you about biking because you have. Can I say where
Oh.
you've changed? You've moved, right?
Yeah, no,
So
I'm
you've
happy.
you've left you left our time zone for the warm, sunny climate of Arizona. Have I got that right?
Yes, Arizona.
So
Yes.
and not only is it warm and sunny, you can do a lot more mountain biking. So you're out
Yes.
doing the biking, and you in years past you've gone to this crazy Colorado kind
Yes.
of race. Why don't you
Yes.
tell people about that and then give us an update? Are you going to do it this year?
Yes. So, spoiler alert, I'm going to give it a try.
Awesome. Great.
But so, basically, 20 something years ago, my wife and I went on a vacation with another couple, to Moab. And, the fellow I was with was a real serious cyclist, and I wasn't at all, but we were going to go mountain biking because there's great mountain biking in Moab, and the ladies were going to go checking around. And so anyway, we rent the mountain bikes, and like a mile out of the shop, I can't breathe. This guy's just buried me, and we spent the rest of the day, crying and screaming and wheezing and whining, and that night. Cheryl said, "How'd it go?" I said, "I've never been so physically humiliated in my life." So I kind of got into cycling, and out east, the road cycling with the people I was friendly with were prevalent. So I got involved in that, and over the years, I got to be a very competent club cyclist.
Okay.
I did some races, very, very mediocre. But, I tried. The problem is, as you get older, the physiology changes, and it's hard to keep doing the high intensity short rides. So I started looking for something which was going to be a little bit different. And a couple of my friends suggested I should take up mountain biking because, it's a little bit more fun, a little bit more interesting. And they have this race called the Leadville 100.
Okay.
And it started maybe 27 years ago now. And it's 104 miles. And you start at 10,000 feet. And it gets up to maybe a maximum altitude of 12,500 feet. But between the start and the finish, not only do you ride 104 miles, you have 12,000 feet of elevation gain,
Okay.
which
Wow.
means it's very steep.
Right.
Right. So the goal for the dilettantes like myself is to do it in 12 hours and under. And if you're over 12 hours, but inside of 13 hours, they let you finish. Over 13 hours, you would have been kicked off the course at some point.
Because it's getting dark.
It's getting dark and cold and bears. And, so I trained. And 3 years ago I did it. And I was like 12 hours and 40 minutes or something.
Oh, you did
like
it.
that,
Well, that's
which
great.
I did it and I finished it, but I didn't get the buckle. Right. So
is that you need to get 12 hours to get the buckle?
12 hours. Right. So I got a finisher medal. It says finisher, but it's
Not the
kind of like
buckle.
schmuck. No, I didn't get the buckle. So it gets better. So I spend the next year training like a madman, and I do the race. So this is 2019, right? So I do it, and I finish it in 12 hours, 0 minutes, and 46 seconds.
Oh, come on.
I'm 46. I'm 46 seconds,
Jesus.
which, by the way, people are like, God, you must feel awful. I'm like, no, I think that's fucking awesome. How great is that?
It's a better
great story.
It's a better story.
It's a
that you
better
just did.
story. It's a better story. But this year, this year I'm really gonna try.
You're going to get the 11 handle.
So
what date is it? We'll all be cheering for you.
August 14th.
Oh, you got a long time,
So,
a lot of training ahead of you.
It's a lot of training.
And are you staying in Arizona this whole time? Like, are you going to be there whole summer?
No, I'm going to be here for another couple weeks, and then I'll probably go to Colorado.
Oh, you're going to go there and live there to train.
I'll probably end up spending 3 or 4 weeks in Colorado at some point between now and the race.
Right, because you want to get used to the altitude as well, right? Like
That altitude is for real.
Yeah,
it's for real.
Oh no, it's like the sports teams that are based out of Denver, and they always end up having an advantage. Yeah. Like they go and they train at the Mile High Stadium? Is that what it's called, right?
Yeah, I think so.
And then they go and then they play at sea level, and it's like extra air.
There's they do the Leadville race 2 weeks earlier, and they cut it up into a 3-day stage race.
Yeah.
So it's like 40 miles, 28 miles, and 40 miles or something like that. Yeah. You might like doing that with your son. Your son rides a mountain bike, right?
Yes, he does. Unfortunately, we have got our summer planned already, and we're going to be out west in Canada. But thank you very much for the offer. And not only that, I don't want my son embarrassing me by crushing me. Listen, Morris, we have to go because Patrick and I have this we're taping this, if everyone knows, we're taping this on Friday afternoon at about 3:30. And Patrick and I have a steak dinner bet that is right at the edge here. And
oh my God, 28 basis points.
And it's lots of excitement. And not only that, it's expiry, and I have a lot of things to do. But Morris, it's been a pleasure having you on. Now I'm going to make sure you do this because you're probably not as good at this. I don't want you to make 3 mistakes in terms of your podcast. Why don't you tell people where they can find it, when it's on, and the whole 9 yards?
It's called Inside Baseball with Old Chestnut.
Yeah.
And we try to have it on Sunday nights.
There we go.
Thank you so much.
It was our
pleasure. Guys, thanks for having me on. I really enjoy spending time with you.
It's always fun, and it's always great for you to share your delightful wisdom and your funny jokes. And you're one of a kind, and it's our pleasure and our honor to have you on. Thanks a lot, Morris.
Well, nice to see you. Take care.
Thanks
Bye,
a lot,
Patrick.
Morris. All right, cheers. Take care.
Okay, Patrick, it's time for Talking Charts. What do you have planned for us?
Let's start off by talking about the top 3 things we were watching last week, and then we'll talk about the top 3 things this week. But last week, we were talking about the OPEX, right? The option expiration coming up. Because of the increased amounts of option volume, there's a lot of things like gamma pinning and all the natural pulling within the markets. And really, it didn't disappoint. I mean, Thursday and Friday in the post FOMC did get a little volatile, but in general, the S&P 500 stayed in the pocket throughout much of that period. Did you observe anything?
Well, I would argue that it wasn't actually a traditional OPEX. I don't think it was as strong as we've seen in the past. I think it had a lot to do with the fact that France went under lockdown. There was a lot of other cross currents that were occurring, and it was it made the OPEX not this much of a center point as it usually is.
Right. So number 2, we were talking about the rotation into real economy stocks. And I don't think that really changed. I mean, the NASDAQ in the middle of the week took it pretty hard on the chin, and things like financials still were being bid. So I don't think anything has really deviated from that theme continuing, right?
I don't know, though, Patrick. The last day, if you look Friday, we woke up and the banks were for sale on the news that the SLR wasn't going to be extended. And I don't know, that might be the shot across the bow for some of those things. Maybe a correction's coming in those
Well, I think that's something to really pay attention to, because I think what's held the market up till now has been the fact that it has only been a rotation. But if we start seeing the financials and commodities and a lot of those value places start to have a profit-taking cycle, that could really turn into some more volatility. And number 1 was FOMC statement. And, it really was in line, and the Fed doesn't seem to be worried too much about anything. What did you take away from it?
I think that he couldn't be any more dovish. And then that's the end of the day. That's what you should take out of it. Having said that, the bond market, everyone thinks that a dovish Fed means the bonds go up. That's not necessarily the case. Dovish Fed, theoretically means more inflation, and it should mean a steepening of the curve, and it means the long end gets sold.
Yeah. All right. So let's talk about the top 3 things to watch next week. And so number 3 We had more Fed speakers coming up. Which ones are you watching? What are you thinking?
Well, there's a lot. I think we have Powell speaking 3 times. We have some others. It just ends up being a lot of Fed speak. It'll be interesting to see because they might be setting the tone. They might be trying to steer the markets. So make sure you listen for any change in rhetoric or for any kind of guides. Which one of our guests says listen to the playmaker? Who was that? I've already forgotten.
Jim Leitner.
There we go.
Thanks to God. Thank you, Leena. You saved me. Jim Leitner with his listen to the Games Master. That's absolutely right. And,
Stop for a second. Is it not hilarious that Leena had to save both of us?
Yeah, that's why we have her. She's like the star. Everyone knows that.
Surprise.
Yeah. We'd be lost without her. Not only that, it would never get out. It would be out like Monday morning if we were, even lucky. Anyways, let's go on number 2. What are we watching?
We were watching whether the volatility returns next week in the post OPEX period. I mean, we've seen, and Brent was even showing a number of charts when Brent Kachuba was showing that volatility tends to pick up in the post OPEX periods, and particularly with the market the way it feels, it's going to be really interesting to watch whether the market breaks. So we'll look at some actual charts in just a second, but anything that you want to add to that?
The only thing I would add is that I thought that this would be a typical OPEX week and we would get the rally and we would get the pull higher. It didn't end up being that way. I almost wonder if, that it's going to, mess me up the other way as well, because I feel kind of the same as you, Patrick. I'm looking for more volatility next week. I'm looking for maybe some weakness, and it's just one of those markets that when you expect something, you almost get hit with something else.
All right. And number 1, we have to talk oil, because what a break that was on Thursday, right?
And then sorry, I didn't mean to interrupt, Patrick, but one of the things that I thought was interesting is that people have come up with reasons for the break after the fact. But while it was occurring, very few people really understood why it was going on. And to me, those are always signs that when a market starts selling off hard for no reason and nobody can really explain why, pay attention.
Right. And so I want to just kind of make some observations technically, right? If you go back to the 2019 price ranges on crude oil, let me just get rid of that minus 40 print here on this continuous contract. But you have all of those major highs that came in throughout 2019 on crude oil that were more or less around this kind of $65, $66 range is where most of these highs came in. And what's really interesting is this very noble animal that we know poked its head to a fresh high above that, to this little prairie dog. And the market didn't want anything to do with it. And after 5, 6, 7 days of just consolidating, I think everyone was just getting a little edgy that it's gone too far too fast. And I think we just got caught in a profit-taking cycle where some big money players have been pressing this trade, said it's time to take bank a little profits.
And I actually think that it might lead the way for a correction in a lot of things.
Yeah. Well, I mean, and this is the interesting part, because inflation break-evens seem to be still, well, they were at least crawling higher yesterday. I don't know whether they turned here today, but we're seeing that a lot of these commodities are coming off of these highs, and it'll be really interesting to see whether or not crude oil has marked a swing high, because we've seen, and like if you go back to the correction back in September and October in crude oil, there was a 2-month correction that was a 20% pullback in crude oil. I mean, if we saw a deja vu of that, which is like following that analog, because it rarely does that, but I mean, I'm just using it as a base case, that would be a $55 crude oil that would be still trading there at the end of April for the correction if it played out very similar to the way it did back in 2020. And with the fact that oil made this big of a move this quickly, I don't think that's out of line to expect some sort of a backfilling correction like that.
It will be deja vu all over again. Okay,
well, yeah.
Let's go.
Anyway, so let's get to some charts. So what I wanted to do, the more interesting chart I thought to talk about was just looking at gasoline. And what I want to do is actually, let me just overlay the gasoline futures over that of crude oil, because we keep talking about crude and the strength in crude. But when you look at the since November, there was a point where gasoline futures were up at 90% versus crude oil up only 60%. Like gasoline since November has been leading the way up in a big way. And we saw crack spreads completely widen out between it, and so it's interesting to watch the fact that gasoline also reversed on all of this, and the reversal in gasoline was also quite violent. I mean, we saw about a 20-cent per gallon drop. On the downside, I mean, we went from what was it, like near 215? It was about a 13% drop in a week.
You know, Patrick, I'm actually a little upset with you. I didn't know you were going to talk gasoline, and I actually hadn't been following it. And I remember buying that, and I was such an idiot. I should have. Now you're just like rubbing salt in a wound. I'm looking at this going, geez, why didn't I just stay with that trend like a mope?
Yeah, no, it was one of the cleanest trends in the outside of copper, this has been one of the cleanest uptrends. But now we're in correction, and that's the interesting part. Crude oil really took it on the chin once gasoline started coming off of its. It
might be the leading indicator.
So I wanted to touch on. Okay, well let's since we said copper, I wanted to just let's look at this chart on copper because obviously you sold the high. Congratulations, rockstar Kevin Muir. But the point is,
I must have been like our buddy Harley Bassman reaching for the buy button, and I confused it. One of the greatest lines ever, written down. Harley Bassman says, the only time I've bought the lows is when I've mixed up the buttons and I went to sell it and I hit the buy button by accident. Great line. I love it. I wish I had said it. It's just awesome.
So, but what's interesting is that after a solid 50% retrace in a span of a week on copper, you would think that if the copper bull was ready to resume, that we should have already been able to break out in some more meaningful way, and it's been consolidating. And Aidan had that beautiful chart about how the rate of change of Chinese copper purchases have been really rolling over, and that doesn't necessarily mean a bearish outcome, but rather that maybe a lot of the tailwind that has been driving this trend higher in price has now disappeared, and maybe we're going to see more consolidation because after such a huge run in copper in the last kind of 6 months, I mean, maybe it taking a pause here is not out of line.
I couldn't agree more. I think there's better things to own.
Yeah. And so what I wanted to do is talk about this uranium participation unit. That's where you can buy the corp that holds the uranium. And one of the interesting things I wanted to get your input on over here, like this is this beautiful uptrend. It's been running really well, but this uranium participation unit has been running ahead of actual spot uranium prices. And so when we pull up that numerical uranium chart here, where it shows uranium prices versus the implied net asset value of the uranium holdings that uranium participation unit owns. What's interesting is that traditionally, the uranium participation unit trades in some degree or another at a discount. And we have now seen almost a month of price action where it's actually trading at a considerable premium to that of uranium prices. And what's your take on all of this? And do you think, are they going to issue something?
I don't know. There was something happened this morning, Patrick. We got up and it was actually down 50 cents. And I'm just pulling it up now on the machine, on the quote machine, trying to figure out what happened. And I see that Sprott, or I don't even know, they're not called Sprott anymore. There's Cormark crossed a bunch, and Canaccord crossed a bunch. I almost wonder if that was the company doing an at the money market deal or something. I'm not sure. I don't know, but it definitely had the feeling this morning like something was up, but then it came right back and closed 543. It wouldn't surprise me if there was a deal coming or if they did it, because as you said, if they can go and they can issue stock at above NAV and then buy, uranium in the open market, that's accretive to them, and that's what they're in the business of doing. Generally, they've waited till, it's at a 5 or 10% premium so that they can do it at an even after their investment banking fees. What's also interesting, Patrick, is that there's been more and more signs that some of these companies are actually buying back, like producers, like miners are buying back uranium in the spot market. And I can't remember which company was this week, but somebody announced that they had bought some back in the spot market. And I have to think that maybe these are companies that are doing long-term deals with their with the actual end users, meaning the utility companies, and they're looking at this and going, you know what, we can replace this much cheaper in the spot
market. Yeah.
And I don't know. To me, it all feels good, Patrick. Like, I'm actually long, the Cameco, and I think that it feels great. I feel like it's one of these little hidden gems, and I think you're long as well. So I think we're done.
I am too. It's the trade is done by the fact that we're both in it.
Yeah.
But the interesting part about this, do you think that Cameco and the uranium story can march to the beat of its own drum?
Yes.
Yes. Okay. Done. All right. Nothing else.
I don't think it trades like it can go completely and utterly all on its own. I think
that's all I wanted to hear from you, because you know what the thing is that so many of these other commodities feel so much like they're correlated to that reflation trade, and uranium took forever to start joining the party, and it doesn't seem to have that correlation. So I think you're just confirming what I was expecting you to say, which was sort of the bias that I had in the first place. Anyway, what I wanted to move on. And just we got to talk about this 10-year yield before we wrap this talking chart segment up. But it just doesn't want to quit, does it?
Okay, I don't want to gooch or anything. Yeah, it doesn't want to quit. It's going to keep going, Patrick. It's going all the way to 2%.
Don't tell me that you are short the rates market.
What, you mean like long bonds?
Yeah.
No, I would never tell you that.
Oh my God, because you'd feel shame. You would never be able to live it down.
Listen, I'm a trader. A trader, if they think that it's going
No, because you came on how many times onto this show, and you said you have only two states. You're either flat or you're short.
Well,
Thank you. All right, perfect. All right, there you go. Rock star over here. Okay. Anyway, that's all we should. We'll wrap it up for that. Let's move on.
Okay, Patrick, time for This Week in Trading History. I think it's a real good one. What do you got planned for us?
You know what? It's a throwback to the 2008 crisis. And you know what? I want to dig a little bit into this one. So it was March 16th of 2008. And so, again, context, because the really ugly part of 2008 was September, October. Right. And so this is fast forward to the first quarter of 2008. And so Bear Stearns at the time was purchased by JP Morgan Chase in an all stock swap worth $2 a share for essentially $236 million. That's M, not with a B. $1 million, right? And so this the Bear Stearns fall shocked even the most experienced traders on Wall Street. Just 1 year prior, Bear Stearns shares were trading at $170 a share, and it was the fifth largest investment bank in the country. And even just 1 week before this deal, it was trading at $60 a share. And the deal is priced at $2, right? I mean, so Bear Stearns had fallen like 99% in just 3 weeks. The final price of Bear Stearns would ultimately be raised from $2 to $10 per share after it appeared unlikely that the shareholders would approve the deal. But regardless, this would end that 85-year-old company's history, it's just one of the many casualties of the 2008-2009 financial crisis. And it's really, I kind of look back at it, Kevin, it's like during a crisis of confidence, earnings and liquidity just don't matter much, right? Because clients and counterparties vote with their money, right? And if the confidence breaks down, the deterioration just follows. Like when you have that crisis of confidence, especially in the financial industry, no firm is really resilient because they were so reliant on short-term borrowing. It's just once that crisis of confidence kicks in and everyone starts pulling, it just becomes like this vortex that just destroys things. So putting a little bit more color on this, Bear Stearns had one of the largest mortgage exposures. They had like $33 billion of mortgage-related holdings, but only $2 billion was subprime. So subprime was the rotten part that basically ruined the whole market. So think about it. It was only $2 billion of subprime loans they had on their balance sheet to basically destroy the company.
Only $2 billion.
Well, but think about it. Like $2 billion, most financial institutions today can write off $2 billion. But
I think that not only that, there was, even though you talk about the subprime was the stuff that got into trouble, but they're using even the other parts of the CDO tranches. If they're using tons of leverage and you have something that's trading at 99 and all of a sudden it goes 90 bid. That
wipes you. The 10-to-1 leverage is the base case on these things. But Bear Stearns had the whole trouble began like 10 months earlier back. It was if I recall, it was May 2007 or something like that, where Bear Stearns had a couple of these hedge funds that I think I have it here. All in there was the high grade structured credit strategies fund and the enhanced leverage fund that basically were just running these subprime mortgage
carry trades. They were trades. Yeah, they were buying tons and levering it up.
And suddenly the redemptions kicked in like in this monstrous way, and so on. Like on June, it's June 7th that Bear Stearns froze the redemptions for investors of those funds. And they lent $1.6 billion to these hedge funds, but in the end, it was July 31st, that summer of 2007, where both hedge funds declared bankruptcy, and it just began the downward spiral for Bear.
And it was such a shame because it really was a terrific firm. I remember very fondly listening to their stories about Alan Ace Greenberg and the kind of the trading mentality that he took, and I remember that we used to get this risk arb report, and it was the greatest risk arb report around. And these guys were true traders, and they were really watched their risk, and it really the attitude within the firm changed really quickly, and it just goes to show you how a leader can make a big difference. And it's a shame because I would have really liked to have seen that shop still around.
Yeah. And so anyway, that's what I got, Kev.
That's a good one, Patrick. I like it. Although I'm shocked that you did not mention Jimmy Cramer with his Bear Stearns is fine, but we'll let that one go.
Oh, you know what? That was one of the classic ones, right?
Yeah.
Like, I mean, anyone go YouTube it when Jim Cramer.
To be fair,
Bear
though, like
Stearns
he
fund.
shouldn't get on there and say, "Oh no, it's in trouble" or whatever. He should probably just duck the question. But he can't come and say, he can't go there and cause a run on the bank. He has a different, he can't go.
No, it's not about causing a run on the bank, but he basically encouraged investors to buy it. This was,
I think it was like a $60, and there was some.
It's a damned if you do and damned if you don't, right?
Like you skip the question.
You got to skip. Yeah, you got to.
You should have skipped it. Anyways, time for skin in the game, Patrick, and you got a big grin on your face. Well done.
My God. Okay. Holy crap, was this close? Like, you know what? I was when Thursday came around and that drop happened and the VIX spiked to 23. Okay, so let's put up an hourly chart on the VIX and just talk through.
Well, first of all, tell people the bet. So we bet last week and
on the VIX. It was the first stake bet that we've made since we changed the format.
Right. Okay, so it was the first,
right?
and it was,
so it's a big deal. It's a big deal.
Yeah, and it was trading around 20.90 or something at the time.
Yeah,
and Patrick said we knew it was going to be an OPEX, so chances are it was going to be less volatile. So Patrick said $20, up or down, and I chose down, and then he wanted up, and we bet the big one. And we went the big one.
You know what? I knew that you had a rationale behind it. It made sense, the fact that usually volatility can compress into that, and that
I was looking
going to
good for
gravitate.
a long time.
My goodness, by Tuesday, Wednesday, when the VIX hit 19, I was like, Jesus, like this is like unbelievable that I'm gonna get clipped on this.
Yeah.
And then Powell opens his mouth, and by Thursday things have gotten
I don't think it
exciting.
was Powell. I think it was the lockdown in France.
Whichever the case, but that Wednesday to Thursday period saw the VIX jump to 23, and I started I was ready to go on to Twitter and do a little victory
You were
lap.
ready. You did, you jackass.
I did not. I did not.
You were pretty
I did
close.
not.
Your members
What
were
did I do?
Your members were already chastising you about tempting the market gods. And
What do you mean? All I did was put the boxed wine I was buying you. That had nothing to do with this trade.
Anyways, okay. So then
I had nothing to do with this trade.
even this morning, I thought I was done. I thought there's no way I'm going to win. And then what happens? A bid comes out of
literally it was at 2-3 p.m. The thing was below 20 again.
Yeah.
I'm like, unbelievable. I'm going to lose going into the actual
It was
Friday
basically the
close.
last tick. It came down to the last tick. Had it been a down bar, I would have won. Had it been an up bar, you won.
It pivoted for the last couple hours going into it right on the 20 handle.
Yep.
You know what? When I go wagyu on your candy ass here, I'm going to take no shame in taking that stake because it was earned.
It was. It was well done. It's a great bet.
Because literally, I think we chose the perfect level and the perfect bet where literally it could have gone either way.
Well, I think you chose the perfect level and the perfect bet.
But you didn't choose so well. But I think it was priced right.
Yeah.
Because usually you will never go to a steak dinner like this.
Yeah, no, you're right. It was fun. You know what? It made it a lot of fun. It was interesting. We both found out that neither one of us pay for the VIX real time though, so that was the most interesting part about it.
The funny thing is Aidan is giving us the quote as to where it's closing.
He's like, you cheap buggers, why won't you pay for the index?
All right, tell everyone the rules of the game, and let's. I have a bet for you.
All right, Patrick, Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle it by the next episode, and the currency for the wagers is as follows. Duke and Duke, a pint of beer, a burger bet, a pitcher, a case of beer, 2-4, box of wine with a $100 limit. I said a box, didn't I? I meant a bottle. You got me thinking box. Steak dinner. The winner of the bet is obligated to create a new bet for the following week. All wagers settle in full, and there will be no netting of positions. I can't remember which one of our listeners was on Twitter, and he said something about the fact that, yes, this is the part where these men wager on the stock market in the meat of animals and beer. In the currency of the meat of animals and beer or something. It was a great line. I retweeted.
I feel no shame.
It was a great line, and it was a great tweet. Okay, so Patrick, what do you got planned for us this week, or me?
You know what? Aidan made the choice for me.
The dollar?
Yes. And I'm going to make this super simple because, look, we've been in a 1 week trade range pretty much right on the 92
Do you really
handle.
want to do this, though? Because
Yes.
I think I'm going to choose up, and you're not going to want to bet me, and then it's going to be a boring bet. So try to figure something else.
92. Forget it. Over, under. You pick.
Oh, you got to give me more than 92. Like, that's not good enough.
92. Over, under.
I'll take over.
Okay. What do you want to wager?
Well, I'd go bigger, but I don't. You're going to go bigger, so let's start with a pitcher.
You know what? I would have preferred to be taking the over, but because all of our pitchers are being because by the way, we got to clarify, we don't net trades.
Yeah.
All bets have to be settled in full. They have to be delivered, and we've been stockpiling pitchers for our Market Huddle piss up. And for the sake of all of our listeners that are going to join us for the piss up, I will contribute this pitcher to the.
Well, you're not contributing yet. You haven't lost.
Well, I would have taken the over, but
know.
you know what? I will not talk the bet down. We'll stay at a pitcher.
Nice.
I'm good.
And listen, for those who are actually interested, the fact that Patrick and I both think the dollar is going up means that you should sell the shit out of it. Don't you think?
Well, at least don't have weekly expiry for Friday.
Yeah.
Like, I mean, you could go long the dollar for a 2-3 week trade. Just don't count on it working this week.
Yeah. Okay. Anyways, let's go on here, Patrick. What do we got?
All right. So no stupid questions. This is where Leena takes
Saves
over.
us. She saves
Yeah.
us.
What a mess, isn't it, Leena?
Yeah.
Anyway, what? Hit us with some questions.
All right. So first question of the week. Great show. You're the best and all that. The side effects I've experienced from listening to it have been SPAC psoriasis and an analysis hemolytic radiolysis. For the
Leena,
most
well done.
I was like,
That was
I
a bit of a
wouldn't have
mouthful
said that.
there.
I would have been skipping that sentence, pulling it out.
I have two questions. The first being more pressing on my mind. My first question is, when buying leaps, if the stock moves in my direction immediately and I'm now wildly in the money, but there is still 10 months or whatever until expiry, is it better to sell and buy a newer at the money leap if I think the stock will continue going up, or to hold? My plan was to ride this XOP puppy steadily to the moon while selling short-term covered calls the whole way, but I'm already in high Earth orbit, and I had to roll the calls hard the last 2 weeks to avoid getting assigned. Should I have just taken the assignment like a champ and re-entered my positions?
Well, that's a good question. I mean, especially it's a little trickier when you're selling short-term calls against a long-term leap, because by calendaring, you're dealing with different gammas and different things that complicate the trade a little bit more. I always, because I love trading leaps, I think they're phenomenal tools for capturing. You get some convexity of that market move on the upside, and then you have the defensiveness on the downside. With these kind of leaps, and particularly on something like the XOP, when you roll up your strikes, what you're essentially doing is reducing your delta exposure. So like, let's say your leap has now reached an 80, 90 cent delta. The leap is now literally a synthetic stock position. You have so much intrinsic value that if the index gets clipped 20% on the downside, you're almost participating dollar for dollar in the correction. And so rolling up the strike on the leap is a way to reset where the behavior of the option has that kind of at the money delta behavior. And anytime you feel that a move is incredibly mature, you really have two choices. Either A, you take your profits, or two, rolling it up is a perfectly acceptable choice. I like to hedge things out and do different ways, but rolling up in this situation makes sense.
So there's a second question from this listener as well. Is writing cash covered puts on stocks you want to buy the most satisfying thing ever, or am I dumb?
It's not as good as the steak Patrick's going to enjoy, but it might be the second one.
It might be a second. You know what? The tactical use of selling cash covered puts as an entry of a stock position. I mean, Cuppy talks about it all the time, which is he sells those monthlies and grabs a nice juicy premium, and if it's put to him, he is more than happy to own it. And so, using those puts as a way to do a quick premium grab on a pullback, I think that the question to that is all about where the stock is trading, because once a stock is trading at a very reasonable price level, I would rather have the risk of having all of the upside, and because I think there's asymmetry in owning it outright. The risk, of course, is that if you sell that cash covered put, it never gets put to you, and the stock goes ripping, 20 to 50% on the upside, and you just grabbed a 10% premium grab. Then it was a bad trade-off. Often cash covered put selling to buy things on dips is when you want to do it. And so I think it's dependent on where the stock is in the cycle. You have anything to add to that,
No,
Kev? Does that make sense?
Genius. Like you nailed it. So.
All right. Well, there you go. Enough said. All right, Leena,
All right.
next question.
Second question. Hi, gang. Love the podcast. Looking forward to it every week. Now, I heard Kevin visiting the other podcast last week, and it raised a few questions. One, is a threesome less awkward the second time asking for a friend?
Kev, you'll have to answer that because
I only wish I knew the answer to that.
All right. Second question is from this listener. Kevin sounded optimistic that the Fed would leave the long end untouched while pinning short rates low. What effect would you expect this to have on the housing market, given possibly rising long-term borrowing costs? Would you expect the Fed to intervene if housing or equities takes a proper turn down despite constant QE? And how, if not through YCC? Keep up the good work.
Okay, great question. A lot of people are looking for YCC. I continue to believe it will be the last thing that the Fed does. And in terms of when they'll do it, I don't think that they're going to do it if equities take a proper turn down, but I do think that they'll be more inclined to do it if housing or the real economy takes a proper turn down. We in the markets often focus too much on, the actual prices of stocks and think that that's what the Fed's tuning for. And the Fed is not tuning for the S&P 500, even though everyone thinks they are. They're tuning in for the economy. And I would argue that they're even more so. They've signaled that they will be trying to not worry about the stock market and actually focusing more on the real economy. And I think the perfect example is in the past when Powell came in 2018 and raised rates. And the easiest way to look at it is you look at the 2-year tip yield, which is the real yield on the short end of the curve. You'll see that previous to that, it had been in a range of positive 50 basis points to minus 150 basis points, all through the Bernanke and the Yellen timeframes. Then he came and he immediately raised it to 200 basis points. So he put 200 basis points of real tightening in. I think that Powell, when he had walked in there, he was adamant that he was going to stop what he thought was a bubble in financial stock prices or, financial markets. And what happened was it turned around, it went down. He realized that not only was he hurting the stock market, he was actually hurting the real economy. And he cried uncle and he turned into his tail and went the other way. I think that was the last time that a Fed will try to go and be influenced by, preemptively tightening in terms of the stocks. But I think at the same time, I think that they'll also be less inclined to preemptively do more, as stocks go down. I think that they are going to care less and less about stocks. I think that was a Bernanke thing and this whole thing about the wealth effect. And I think they've come to realize that it's not as important as they think. So I know that's going to be a unpopular view. I know everyone in the markets will tell me I'm wrong, but that's the way I see it. So I don't think that you should focus on that. And I think that the other thing to think about is when you're thinking about whether the Fed does come and do something, I think that the more so than the absolute rate that matters, I think it's going to be the pace upon which it rises. So if we had a situation where the bond market just kind of chugged higher and next thing you know, it's 2% kind of 6 months from now, I don't think that's going to be a bad thing. And I don't think the Fed's going to have problems with that. If all of a sudden we turn around tomorrow and the Fed it's 2% and gapping in 5, 10, 20 basis points, that is when the Fed will get involved. So that's my,
all right.
2 cents.
All right. So last question for this week. How do you guys change your own mind? I remember reading the blog last summer and getting bullish on markets, stay-at-home names, and green tech, especially with the recent market rout. I'm anxiously hovering over the sell button, but my inner bag holder refuses to ring the bell. I know part of this is I believe there is more room to run, that I own solid names for the next 12 plus months and creating short-term gains. But Mr. Market seems to be telling me I am not positioned properly for the inflation or value rotation. I have discounted these factors and wondered to myself whether I am minimizing the risks so that I don't have to change my mind and admit I am wrong to stay in the trade. Any tips or tricks you have in this regard would be awesome. Love the show.
All right. Kev, you want me to start?
Yeah, you go ahead.
Okay, well, I mean, the first thing that I observe here is, our listener here is talking about that they're looking at a 12-plus month time horizon and then asking, how do you change your mind? The problem with a 12-month horizon is that you need to see a large data sample to really start to realize that the storyline is playing out slightly different. For me, the problem is I don't live in that time frame. I'm far more of a trader. So while I love these big macro themes, to me, I combine technical analysis with the big macro to kind of combine when the macro theme is actually starting to materialize and when it's actually offers some asymmetric way to apply the trade, rather than simply making it and then putting on a trade and not knowing my exit or where I'm going to take profits. And this is kind of a style thing, isn't it, Kev? Like, 'cause each of us as traders have a very unique way of approaching this. Like, what would you say to that?
I would agree with that, and that is also too long a time frame for me. Having said that, one of the things that most traders will tell you is that you should know where you're going to get out before you get in. So there should be a price stop in general that you have. And the other thing is that maybe you should think a little bit more of trying to figure out what is your exit strategy? What are your conditions upon which you would no longer want to be in the trade? And just because the market is not agreeing with you right now, are you getting nervous because maybe you don't have that plan? And often, you get more nervous when you don't know what to do. And so if you actually take a little time to sketch that out and think about it, absence the emotion of what you're seeing, it might be a lot easier for you to go and actually execute on that and feel better about it. So that'd be my kind of 2 cents.
There you go.
That's 2 cents times 2, 4 cents today.
4 cents today. All right, that's it for that. Leena, where can they submit their questions?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right. Thanks a lot, Leena. All right, Kev, why don't you take us to the close here?
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter. You guys know it's Leena. I'm behind the wheel there, and she gets tired of talking to Patrick and myself. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And I guess, what, I should give you a little bit of a nudge. Please sign up for our email so that when you do get guests like Aidan with huge decks, that you're able to actually follow along. And then finally, I was going to ask you to rate us and review us on iTunes, but I thought that something would be a little more fun. Leena pointed out someone that is a true huddler. He took the time, I assume it's a him, but maybe not. Drucker Mon took the time to write a review on iTunes. I thought I'd just like to share it with you guys. He said, Dumb and Dumber meets trading and markets. Best podcast, period. Subscribe and forget the rest. Now, thank you so much. I thought that was the perfect huddle kind of.
But which of us is the dumb
exactly.
and which is the dumber?
I was trying to figure it out. It's I don't know. I kind of feel like you get Jim Carrey. I kind of feel
I was about to say you.
Maybe, I don't know. Tell us who you think is Jim Carrey and who is the other guy, the guy from the newsroom.
All right, Kev, where can they find you?
I'm on Twitter at Kevin Muir, or you can go check out my newsletter at themacrotourist.com. And Patrick, how about you?
They can follow me on Twitter at Patrick Ceresna, or you can do a free trial at bigpicturetrading.com. All right.
Listen, we can never have too many friends, bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. Okay, let's get this beer out of the way.
Oh, my God.
You really didn't like it.
Oh, God. It's got coconut in it. Like, you just don't.
You know what? The show is done, and I have 1/3 of a can. And I won't lie. I actually have a second beer because.
Yeah, well, that's what, for sure. It's
Really?
undrinkable.
I liked it.
Oh, my God. Really?
It almost tastes like, in the summer, I don't know if you guys do, but, I'll go to a coffee shop and get like a cold brew
I thought you were going to tell us you go to Hanlon's Beach.
Oh, well, I've been, but that's another story.
Well, since you went there.
This was when I was, in my early 20s. But anyways, this beer.
You probably were the only early 20s person on that beach.
It's a bunch of 50-year-old pervs. Yeah.
You guys would be surprised. There's a lot of youngins there. Anyways, this beer tastes like a cold brew coffee it's like a spiked iced coffee.
Yeah.
That's what it tastes like to me.
It's terrible.
I don't know. I like it.
I like coffee, and for that, it was. I appreciate that there was a coffee taste, but I think back to when we featured the canna beans from what was it, a couple weeks back, where it was that coffee blonde.
No, that was
beer.
last week. That's what I was
Yeah.
like.
Was it last week?
We got
Did
two
we
in a
just do
row.
two?
Yeah, we did
Two?
two
Well,
in a
no, I
row.
knew
I-
Kevin. I knew you weren't gonna like this one, and because you lost the bet, I figured, well, I'll just sandwich
You
all
just
the
throw it
badness
on
together.
there.
No, so-
Piling on. I like it.
But I would take the can of beans, the blonde version of this, way. Like I thought that one.
I would
was-
take my dogs like.
Shut up!
bowl
Shut up!
of
Don't
water
even.
before I
Come
took
on,
this.
This
Like,
is good. This will be good in the summer.
okay,
I like
I'm gonna
it.
just get my thing out of the way. I'm giving it a 2-1 on the
What?
2-1.
I don't. I've never heard you score something this. This is the
2-1.
worst.
Listen, I'm
beer you-
making a second category though. 2-1 for the beer, undrinkable. But the can and the marketing and everything like that, they got me to buy some. Oh no, they got me to get. We don't buy any of our beers; they're all sponsored. They got me. I love it. I'm giving the marketing and everything else a solid 9.
Yeah, the marketing's great on this. Yeah, for sure.
But terrible beer. They need all the
Terrible.
marketing they can get. Patrick, what do you think?
I'm gonna get a 5.5.
You guys.
5.5.
Wasn't
Like, you know what? I will never buy this beer. I'm sorry. You know what? Like, I'm sorry. You know what? I love Great Lakes. They're actually like 10 minutes from me.
Yeah, it's not too far
the
from
thing,
me.
and they have great beers. And so I want to do a shout out for a great brewery, which has one beer within there that is not buyable, and the rest are really pretty awesome. So I would never want to discourage people from going to the brewery. But this is not the one beer I would drink. that's
But
for
you know
sure.
what? Some people like them. Now,
I like
Yeah.
it a
tell
lot.
us what you'd rate this.
I would give this an 8.9
Oh my God.
because I would drink this again.
I just
The only reason why I didn't give it over 9 points is that I think I'm good after just one.
Yeah.
I don't think I can drink a second serving of this.
oh,
But
so it's not sessionable.
there's that word again. But
So,
I
Leena,
liked
you
it.
know what? Usually, often our tastes are similar, and if you were to graph the Leena Kevin spread, this is by
It's all-
this is
This is
blown
the
up.
widest-
This is a
this
10 sigma event. This is a
Yeah.
10 sigma event.
There's a lot of
Because
crazy things
when it stopped
happening
at
in this
the
episode.
so what happens at the 4 sigma mark, Kev? Because it never stops.
It never
at 4,
stops
right?
at 4. The trouble about 4 sigmas is that they always turn into 10s.
Yeah,
That's what everyone.
this is definitely a 10 sigma event.
Yes, it is.
If
Oh, well.
you like
Anyways,
iced coffee that's spiked, this is
I'm glad
for
you liked it, Leena. That's awesome. Okay, so
She saved it. She saved it.
she did. Well, you know what? You know, maybe Great Lakes will still talk to us. They definitely won't be talking to me. So now, Leena, I guess because you interact with our guests a lot, or our listeners a lot more.
Yeah.
I take it that Louder Milk
Yeah.
just got released in the States.
I think so. I think there was a couple of weeks back somebody did mention saying, "Oh, it's available on Amazon Prime now or iTunes." I can't remember which platform, but it is definitely available in the U.S. So that's good news.
Because I have heard about people cursing me because I've ruined their weekends because they've been binging watching it. So there's been a lot of people that have liked it. I love it. I actually thought I should watch it again. I was like, I'm such a fan.
Well, if they're binge watching, obviously they like it too.
Yeah.
then.
Now Patrick told me that I got to do Archer. He's like, I'm gonna do
Oh,
it.
did you try Archer?
I didn't yet. I didn't. I actually had a busy week, so I can't do anything.
Oh, I've been crushing it. I have not been watching a series like this like since Game of Thrones. Like I actually normally I
created a
don't
monster.
watch. You created a monster. It's so fucking awesome.
Okay, well I gotta watch
Like,
it. If you like it this much, I gotta go watch it.
It's my type of comedy. It's it just like nonstop.
Patrick.
It's like
Do you know the guy who does the voice for Archer, the main
yeah, it's
character?
Bob Burgers or
Yeah,
something.
he's the
or-
same guy that does the voice for Bob's Burgers. You can't
Yeah.
get that out of your mind once you watch both.
No, that's fine. It's hilarious. I picked that up pretty quickly, and it doesn't bother me.
Oh.
It doesn't bother me. It's anyway.
Okay.
Like look at this. It took me 11 seasons. Like it takes a decade for me to find a show. Like there's some listeners.
No, but they're
that are
so
right now-
good though when you find something that's 11 seasons deep, because then you can
because you got so much to go.
exactly like you find something today they're just building and you're just
Oh,
like
there's
like I'm
yeah,
actually
there's
glad that I
listeners
only
right now.
figured out Louder Milk 3 seasons in. If I had listened, started at the beginning, it's like
Then you'd
Ted
be, like,
Lasso or
suffering.
whatever. Everyone loves Ted Lasso, and Lasso. I sound like I'm French Canadian or something. The Ted Lasso, everyone loves it, but the trouble is you have to wait, and it's only one season. You can't go crazy like you
yeah,
can with
you
Archer.
Can't binge watch with that.
Yeah.
Yeah.
No.
Anyways, Leena, did you watch anything interesting, or to have any stories to tell?
Last night I watched Making Coco, the Grant Fuhr story.
The Grant Fuhr?
Yeah.
The goalie, right?
Yes.
I didn't
hockey
even
player.
know.
Oh, the Edmonton Oilers
Yeah.
goalie.
What was this? What was it about?
It's about his
Well, I
life.
know- yeah,
And,
guess
you
so.
know,
No,
obviously.
it was-
but
it
you gotta
was
watch
about
it. It's
farming.
It can get a little teary. It's inspiring.
Oh, I didn't know that.
If you're into hockey, I think
There
it's
we
a
go.
must watch.
That's what us Canadians do when it's cold and we're stuck at home. we go watch.
Yeah, it's March, but I'm still out there with my winter jacket, so
Yeah, it still hasn't. It still hasn't heated up. We actually got a little. They teased us with it. We had a couple of days, and now it's back.
yeah, I went outside today. I thought my face was gonna fall off, so there was that too.
Lucky I didn't go outside.
Here it is, Making Coco.
Yeah,
Is that his? Was that his name? I didn't even know. Yeah, it is.
I guess they called him Coco, but we'll leave the reason why. I think,
Oh,
but we'll leave it there. But it was a great documentary. It was beautiful.
because he likes the cereal,
We'll leave it.
Stop
We'll
it.
leave it there.
the Cocoa Puffs. He just likes the cereal. He likes
Mar-
the Cocoa Puff cereal. That's all. I don't know what you're talking
right.
about.
Yeah, that's exactly.
Yeah.
All right, so what else is new? You guys do anything fun?
No, I didn't do anything.
So we're out of things. Let's just wrap.
No,
it.
there's another.
Oh wait,
show
I'm
I
sorry.
watched.
I'm sorry.
There is another show I watched.
Okay.
Unabomber on Netflix.
That's
It's
like super old. Like we
No,
watched. that-
Unabomber in his own words or whatever.
Oh.
It's like you get to listen to the tapes of his interviews, and he's only done interviews with like a handful of people or this one person or whatever, and it's pretty chilling and it's very interesting.
Oh God, Leena, you got to watch that thing on Saturday Night Live that I told you about. There's something about you guys.
It's like I can't really watch horror movies. I get really
Yeah, but like
I get
real
scared,
things that
but,
are real
you
things
know.
are. Oh yeah, put
I'm
them
like,
on.
oh yeah, I gotta watch this. I gotta make some popcorn. Let's sit down and
So how
binge
long
watch.
was this? Like I just watched 14 hours of the Unabomber reciting things out of his.
No, I think it was like 4 episodes. I want to say I watched it in a couple of days, so it's not very long, but it's interesting and it's you kind of understand why he went off the deep end, kind of thing. But obviously, it doesn't excuse what
Justify
he's done.
it.
But you can see what kind of damage society or other people around you can do on an individual. So it was a little bit sad and also interesting in that regard.
Wow. Well,
Well, on that
okay,
note,
on that lovely note, Patrick, let's think of something nicer to talk about before we leave it. You got anything planned?
Me, I'm gonna watch some rugby tomorrow.
Really?
Yeah, my buddies are all into that European rugby, the 15s.
Is it one of the
so,
teams that Louis owns?
I'm not sure. It's I watched on just this past Saturday the England versus France match.
So Patrick, do you have any idea what's going on?
Yeah, you know what though, but I'm a newer fan to rugby.
Okay.
In other words, when they had the Pan Am Games, how many years ago in Toronto, we went to watch the rugby sevens for the Pan Am Games, and I was instantly hooked.
Really?
I became a rugby fan then, and so I'm only a few years into it, but what a great game!
Oh.
I love it.
what do you love about it out of all the other sports?
Because they're very similar to like the way in soccer. It doesn't stop very often. The game just is perpetually moving. So like in normal like American football, everything is about like stop. They set up and they go. Stop, set up, and go. In rugby, it's just non-stop. They're just like you're just going and going and going, and it's just so exciting because it's just like you can't take your eyes off the game because something big's about to happen. And so I love the energy level of it. It's anyway. I was a big fan. I'm gonna watch this weekend's game.
He just sorry to interrupt, Leena. He just likes any sport where you have to tape your ears shut. I mean, to your head so that you don't get them ripped off.
I was gonna say, do you like any sports where you have to lose a lot of teeth?
Yeah, I like hockey. I like rugby. Hockey was better when they didn't have face masks. I actually liked it when they didn't wear helmets and they smoked on the bench.
Yeah, that was hilarious. Remember when Mario Lemieux on the Penguins, he'd be like in between like shifts, he would go and have a smoke.
No, it's Guy Lafleur. Mario Lemieux didn't do that.
Yes. What do you mean, Mario Lemieux totally did that?
Really?
Yes.
Okay, I gotta look this up because that does. He's not that old. Smoking on in between shifts. You think he was smoking like?
Abso-freaking-lutely.
It was a different time. It
was like you. Anyway, so like, but that would for sure. I
didn't know that. I did not know that.
But
Mario Lemieux was one of the first guys that when you used to get the cup, and they used to only give it to the stars, and I think he got the cup, and I think it was him, and they lost it, and it was at the bottom of the pool.
Oh my god!
And then from then on, they had to like put like a guy in charge of it, and like the whole night. I'm pretty sure I could be wrong. All the Canadians will be like, "No, you idiot! It's blah 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 blah." But I'm pretty sure it was Mario Lemieux that did that. So he obviously liked to party. This guy.
Oh, yes.
Yeah. Like
but more importantly, where are you guys settling this steak bet?
I don't.
Oh, well, that's yet to be determined.
I was hoping I could just buy something from Loblaws and cook it on my barbecue behind me.
Like a nice little skirt steak.
No way, dude.
I know, I'm just kidding you.
But I do know a great place down the street from me that sells a great Wagyu steaks.
Oh, you and your Wagyu.
No, but listen, I'll cook it up. Like, I'll let you off the hook of you paying a restaurant premium.
For this Wagyu? Okay, well, I've never had it, so maybe we should do it just to try it. Like, what is this going to sell? Is it like $1,000 or like is it?
No. Like, if you buy it there, it's probably going to be, well, like, I'm not going to say. It's better you're surprised.
Listen, I'd like to try that because I've never tried the Wagyu. So if you actually know that, I'll get a nice bottle of wine. I'll find something
I've got
that's
a really
not
good
in a box.
barbecue. I have a really good barbecue I'll fire it up properly.
Okay, well, you're on. So why don't we do it sooner rather than later? Like as soon as we're technically we're like right now we'd be breaking the law, but as soon as
we wouldn't.
Yeah, we would. I'm not allowed to come there.
But yes, you are because I have a great heated backyard.
No, but I think you're still not supposed to do it. There, well, listen.
No, yes, you are.
We're gonna get
Depends
easier.
on
And plus,
it's
my God,
cold
you're
right now.
such a wuss.
It's cold right now. Anyway,
I have freaking heaters back there.
Anyways, well,
Patrick just wants his steak.
Yeah, he just wants his steak. He's like,
no, you're just full of excuses.
No, I want to do it. I don't need to do it in March. Well,
anyway,
let's do this thing because I wouldn't mind. I wouldn't mind
doing
a Wagyu. I've never done it, so
in the spring.
It's going
to
be delicious.
Yeah,
Leena, you'll come out.
Yeah,
right?
you can come and have
for
some
Wagyu. I'm coming out.
All right.
Okay. Well, on that note, thank you everyone for tuning in.
Yeah, it was a good show.
A lot of fun, and it's a lot of fun. And have a great week. Stay safe, everyone. We'll see you next week.
All right. Cheers, everyone.